great franchises. We have Mission Impossible coming out a little bit later,
Haven't seen it.
Transformers. So they do have a great pipeline. They just don't have enough to be viable on their own. So the big question is, is this going to be an M&A target? I think most people think it will. There's been a lot of interest from Berkshire and Warren Buffett. He has almost a 16% stake in the company. But again, fundamentals on their own, not looking too great.
Okay, we talked earlier with respect to Disney Plus and some of the others that now platform is king and not necessarily content in the same kind of way. Would a Berkshire Hathaway takeout be what really is most effective for Paramount, or would it be an Apple? Would it be some company that could merge it with another platform that could give it more visibility?
Absolutely. I think at the end of the day, it is definitely going to come down to M&A. The problem with Paramount Plus is it still has substantial exposure to the linear TV business model. And that's a business model not many people want to get into. So almost 60% of their revenues still come from, linear TV, whether it's TV advertising or affiliate fees. So I think eventually when there is an M&A deal, it will have to be pieced out. So maybe the streaming platform goes to a particular player. The studios definitely are the most valuable part. Apple has been a name that's come up many, many times. Could also be another media player like a Comcast. You mentioned Peacock, Comcast, or maybe a Warner Brothers Discovery. I don't know, but we'll have to see.
What's the model that people are talking about? John was talking about the difficulties of trying to find anything and finding one season on one platform and another on another. Is this going to be bundling? Is it going to just be mass roll-ups? What are people talking about right now?
I think it's a little bit of everything. I mean, eventually there is going to be consolidation. There has to be a streaming shakeout, and we probably see about 2 or 3 major must-have services and all these other smaller niche type of services kind of rolled out into those big dogs, if you will. It is going to be consolidation, but as you mentioned, discoverability and the power of the platform is really, really important. Paramount, unfortunately, because of their size, they haven't necessarily been able to go all into streaming. John just mentioned how, certain seasons of Yellowstone on certain platforms, and here again, they can't pick a lane. I mean, in the streaming wars, we've always asked companies to pick a lane. Paramount, unfortunately, doesn't have the luxury to do that, Brilliant. So they have to license out some of their content. They have to keep some for their own. So, you'll see 1883, 1923, which are the Yellowstone spin-offs, are on Paramount Plus. So the newest content on Paramount Plus, but any of the older seasons, you got to go to other platforms.
Geetha, we were also questioning the future of the movies that were being made and how they'd be rolled out. In the pandemic, I think many of us felt like it was the end of going to the movie theatre and watching the latest release. And then you had what happened with Top Gun Maverick, where Tom Cruise just said, wait, we're going to wait, and you're going to have to wait even longer until this can be available at movie theatres. Geetha, how much did that change the game?
It absolutely did. I mean, your quote about Steven Spielberg, I think that is absolutely true. In so many ways, we've seen Top Gun Maverick kind of really resurrect movie going in such a big way. And then we've seen, so many other movies perform really well too. Avatar, of course, is the latest example that has just done so well. And Top Gun Maverick itself, over 1.5 billion at the global box office. And I think what this has really done for studios in general is it's told them that, theatrical is really the way to go. And if you have a big blockbuster that should be seen in theaters, it absolutely should be seen in theaters. That said, I mean, box office has recovered, but I think we're still not going to see the numbers that we used to see before, which was $11 billion in ticket sales at the North American box office. So a lot of the smaller movies are definitely going to go to streaming platforms. But if it's a big budget, big blockbuster, it definitely is going to go to theaters.
Loved that movie. Just absolutely brilliant. Geetha, thank you. Geetha Raghunathan
She's
on the latest.
I love it.
Paramount numbers coming a little bit later. I can sense from your face and the way you've looked at me that you haven't watched Top Gun Maverick, and you still haven't watched the original, have you?
Okay, guys, I haven't watched Top Gun. I haven't watched.
You are killing me. It was in one look, Bramo. One look, I knew straight away. Have you never watched that movie?
Dear, don't speak to me like that,
How has that not happened? Has that not happened?
I've got so many other things to do. I can't.
Let's talk about your childhood.
TK, it's so good. I cried in Top Gun Maverick. I get that emotional watching it. I get emotional on planes. Right if I see someone watching Top Gun Maverick and I see a certain scene, I'm like, here we go.
I haven't seen Yellowstone. I cry more watching any movie on a plane.
Always.
Why is that?
I've got no idea. I'll tell you a story about the British Marines. My brother-in-law.
Please, this is scarier.
The original Top Gun. So they would play a game with the original Top Gun, and him and his friends could hit pause on the original Top Gun on any scene, and they'd all know the next line of the movie. They'd all know the next line of the movie, Tom. How cool is that? People memorize this stuff. They love it.
Can I say that I believe some people are saying they actually have a chance to have a real movie like Top Gun win the Academy Award this year?
How much is this also, though?
From,
the love that you talk about for a franchise, those franchises really leading out front with some of the sales and the new movies. I think that that's interesting.
Well,
less risk.
There's less risk. You can put the budget in and people come.
The difference here is John tears up at Top Gun. I tear up at Ted Lasso.
When's the new season? When's the new
March
season?
1st.
Oh,
be
very
there.
Cool. Okay.
Mandalorian as well. Favreau's coming out with another spread, you know.
Nice. All right, I look forward to that.
I watched Ted Lasso, I'll admit to that.
I look forward to this. Peter Chi of Academy Securities is going to talk to you about what 0DTE means. That's next.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Why 1953 specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "Don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period: to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
There's a lot of things that the market is getting wrong right now.
We were mispriced, I think, for the path of Fed policy. And now I think we're getting back to a more realistic level.
Now the market's starting to think the Fed's going to go further than they are communicating right now.
Some of this rally is chasing. It's the FOMO rally.
We are in an every data point matters type of environment now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's a snapshot of the year so far. Yields are up. We're pricing in a higher terminal rate at the Federal Reserve, a higher peak rate, so to speak. And tech stocks are outperforming. We're going to try and figure that out for you from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures right now basically unchanged on the S&P 500, but that tech outperformance, TK, in the last 24 hours continues.
Almost got down to a 17 VIX. That's a huge deal for me. This is a regime shift from a 21, 22 VIX, Standard & Poor's 500 vol, down to 18, 19. We're at 18.51 now, but yesterday afternoon, almost to a 17 handle.
Off the back of decent data, Tom, retail sales with a 3 handle, a blowout jobs report, jobless claims around 200K,
GDP.
And yields at new highs for the year.
Nominal GDP, just the animal spirit that's out there. The roses, you bought the February 14th roses. I bought the February 15th
What did you
roses.
get on February 15th? What
I got a
was the sale
discount,
like?
thank you.
20% off?
No, we did better than that. We did about 28%.
Oh, good. I hope Mrs. Keene's not watching this morning, Lisa. 28% off on her
You know what's
flowers.
great about this show?
That's what he focuses on for Valentine's Day.
For those of you, the inside baseball here is people watch us and listen. We're so honored by Global Wall Street. It watches us. There's a guy down in Florida, lives on the beach. He's made it big. His name is Doug Cass.
Okay.
He goes out and trolls on the beach waiting for famous people to walk by. So a couple days ago, Michael Nathanson walks by. Cass has got his floaties out. He's ready to go into the ocean. He corners Nathanson.
And wants a call on
Paramount. And one of Cass's calls for Paramount is Paramount to be acquired by Berkshire Hathaway Apple Consortium.
That's what Lisa mentioned as well. There's going to be a story for us a little bit later this morning when we get earnings. I'm going to whip through the price action. Lisa's going to go through the day ahead because we've got a guest in the studio I want to get to pretty quickly. Yes. Futures are unchanged on the S&P 500. No real drama here. Yields are coming in a couple of basis points after pushing high yesterday. Lisa, your 10-year, 378.38.
To build on what you were talking about around the head-scratching rally in tech, how much is this disinflation a head fake? And the 8:30 a.m. data that we're going to get, I think, will really speak to that. The PPI, in addition to the jobless claims and housing starts and building permits, and the housing starts side, you're starting to see optimism really surge back with lower mortgage rates, at least briefly. PPI, how much disinflation are we truly seeing in goods, especially as you see the likes of used car prices start to tick back up? Today, European central banks speak. They're getting in on it too. Bank of England Chief Economist Hugh Pill, Deutsche Bundesbank President Joachim Nagel, ECB Executive Board Member Philip Lane, everyone really taking a look at that 2-year yield. And I keep going back to what Holger Schmieding said over at Berenberg, this idea that even with less accommodation from central banks, stocks can still keep rallying, but perhaps bonds are having a bit of a tougher time on the front end, giving you that kind of yield. And today, the Fed speak includes Cleveland Fed President Loretta Mester, St. Louis Fed President Jim Bullard, and Fed Governor Lisa Cook. Perhaps they can speak about the meme stocks.
Some ECB speak and some Fed speak as well.
She's great. I'm waiting for her to have Japanese speakers come up.
That's
who's speaking for the BOJ today?
We've got to find out, haven't we? We
don't
know after Kuroda. Has that been confirmed? Ueda?
Yeah.
Is that confirmed now?
Yeah.
That's confirmed?
Well, it hasn't been confirmed, but he's the nominee, right? He's the one that's going to be the person, and the question is, does it really change anything?
Good to know. Peter Cheer, good morning to you. Alongside us in the studio, good to see you. The head of macro strategy at Academy Securities. I said thank you.
Thank you.
I'm just being obnoxious.
Those of you in radio, the cheer charts are something.
Is he logged into the Bloomberg already?
Well, of course he's
Always. I live on Bloomberg. I got to admit that.
Well, Pete, that's good to know.
Mike showed him the door when he came in.
Marko Klinovic of JP Morgan made some headlines in the last 24 hours. He's had a difficult time calling this market over the last 12, 18 months. The US equity market anyway. And he had this phrase, Volmageddon 2.0. And in it was this acronym, Zero DTE, 0 days to expiry. And I think a lot of our audience are hearing more and more about those options. Can we have a bit of a clinic here? Can you define for all of us, what is 0 DTE and what is it doing to this market?
So every day now they create options that expire either that day or the next day. So there's a huge volume in that. And there are weekly options as well. So Single stocks tend to be more weekly. ETFs tend to have the daily. And volumes have just been driving through that. And I think it has a couple repercussions. One is people are really literally gambling. And you can sit there, there's a Bloomberg screen called MOSO, which is the most active traded. It's almost like watching a horse race. You'll see the SPY 412 calls, then the SPY 413 calls, SPY 14. It's almost this laddering. So I think people are trading a lot of this. Volumes have exploded. For as much as 40% of equity volumes can be related and tied back to the hedging of these single-day options. So it's a very massive driver, and I think it's why we're seeing moves just that are amplified. So maybe something that would be a 0.5% move based on the news becomes a 1.5% to 2% move, and it's going in both directions.
You touched on it briefly. Can you explain how this becomes self-fulfilling for the people that, let's say I am an institution and I sell you some of these very, very short-dated call options. What do I have to do on the other side?
Call, way out of the money, right? 1.25%. All of a sudden, as it starts going to 403, whoever sold that call has to start buying SPY, which tends to exaggerate the price move. Then it starts getting to 405, they've got to buy more. And then what we're seeing happen is someone starts buying the 408 calls. And that starts putting pressure. And you see almost this laddering type trade, and it occurs over and over. And I think it reminds me a lot of what we were seeing about 1.5 years, 2 years ago, where you kind of had those gamma squeezes. And that was very much individual stocks. It started on Monday with people buying the weekly options, and now it's moved down to this daily option. And it's the other reason I think VIX is kind of irrelevant to me. So VIX only calculates options with 27 to 35 days of expiration. Right. As more and more people gravitate towards these daily options.
To the roulette machine, yeah.
Yeah, and the volatility doesn't get picked up in that. So I think that's where the surprises are going to come. People are looking at VIX for the hedging. It's all occurring in this daily and weekly options.
Let's do Myron Scholl's 101, 1998. It's a rule of thumb. Options are derived out of 4 times leverage. Futures derive out of 10 times leverage. With these short-dated options, what is their leverage equivalent? It's got to be way higher.
Way higher. I think it's the hundreds to one. People
really
like
that high. You're going to go way out past futures.
Oh yeah. Again,
when do the regulators step in here? This is a train wreck waiting to happen. You and I know it.
I think people are going to start looking at this. It's really hard to figure out what justifies this. You're starting to see, again, all like the meme stock type things where my Twitter feed's filled with people who promise to make $1,000 into $100,000 because it's truly gambling. There's no binomial model or anything that's going to predict this, right? You buy something out of the money and you hope it triggers. And what we're also seeing, I think if you look in the background, on the days calls are working, people really push hard on some of the most shorted stocks and vice versa.
So to stay away from the jargon, gamma, folks, is basically a form of acceleration. What is going to happen is we're going to have a level change due to news, whatever. Equities are going to go up or down. What will then happen to the people playing a one-day duration in a leverage way out past 10 to 1?
Well, the people who get it right are going to make a lot of money. They're going to keep pushing.
What about the others?
That's where you'll see liquidity start pulling back. And I think that's what happens now is you've got all these algos kind of with this full level of liquidity, right? They're all kind of scalp a tiny bit. And as these moves start, they pull back.
Do you believe there's risk here on major Wall Street firm desks?
I don't think it's there as much as individuals, though I think it's really has started gravitating more and more towards, retail, not just retail traders, but institutional traders are gravitating to this. You're not getting these types of volumes because it's mom and pop or the kids playing. This has definitely hit the big institutional desks as a trading strategy.
What's the larger consequence of this? Is it a matter of just really muddied signals from a market that doesn't really cohere with any of the larger economic trends? Or is this something that's a more significant whipsaw waiting to happen and a sort of unexpected downdraft that could happen suddenly?
So I think the first thing is it's just much harder to get a good read on the market, right? These moves are amplified, so you can't see that. You've got to be watching these things or else you're going to miss signals. I think the most obvious day was the Thursday after the FOMC when NASDAQ was up 500 points. You could just see this really trading through these 0-day to expiration options. So you've got to be watching this. It dilutes information. And I think you just have to be prepared that whatever you think it could move, if you think it's a 1%, 2%, 3% move, you could get 5 to 10%, I think, much easier.
So is it just a matter of volatility, or does it also affect the trajectory, sort of the directionality and also the persistency of a rally because of the self-fulfilling aspect?
I think it can. It can make things extend a little bit because it just makes it, if we live in a world where there's kind of almost windshield wiper algos, you're looking to who you can stop out, shorts or long, it makes the chances that they hit triggers higher, and then you keep pushing it higher and higher, right? And you get these much more exaggerated moves, which forces everyone who's short to close out. And now I think you switch back. And the other thing I think it has really done is, as a contrarian, you're always trying to figure out, okay, what's market positioning? And you want to bet against that. I think market positioning now turns on a dime. The ability to move huge amounts of risk through relatively short-dated options, I think has changed that risk positioning. So it used to take weeks to a month for everyone to go from overbought to oversold. I think these things happen in days or weeks now.
So what's your projection of how this plays out? We've heard all these cute narratives trying to pin off the heels of certain market action. How does this play out as you see the boiling of the frog with respect to higher rates in the front end?
If it's like everything else, I think what we'll see is one down day where we go through some of the triggers that, stop the exchanges, and then regulators will pay attention, because no one ever pays that much attention when the bias tends to be higher. I think it's going to take a big down day where no one can explain why it's this. We start hitting all these triggers on the NASDAQ and New York Stock Exchanges.
And is that the Volmageddon 2.0 that Marco's talking about, a kind of repeat of early 2018?
Yeah, and I read a bit of his. I think it's a little bit off there, because the one thing that we had in 2018 was people trading the VIX directly. There were all those VIX ETNs, and they had that ability to actually trade the VIX futures, and there were really interesting trigger points at 4 to 4:15 p.m. that let people push that. But yeah, I think we'll see this, and I think you're going to see how I look at liquidity, whether it's in the bond market or equities. Again, it's all these little algos fighting around, and as soon as they start losing money, they start shutting off, and bid offer goes wider, and that's why you're going to see these exaggerated moves.
I hear now annoyed to Cheerageddon.
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 Or Cheermageddon.
Cheermageddon?
Cheermageddon's better.
Okay.
I've been trying to be cheerful in
chart banner in the control room. Pharaoh's smarter than me.
I think that's great. Have you watched Top Gun before?
Of course I have.
There we go.
I don't know if you saw, but ahead of it, one of our the generals and admirals I work with, General Wallace, was actually a Top Gun instructor. So that was pretty cool hearing his stories about that.
What did he say? Did he like the movie?
That I should watch the movie.
He said that the movie was fairly realistic. There were all sorts of people at this, and there were some people who were just phenomenal pilots, not necessarily great people, but phenomenally pilots, and there were others who were great people. And it really was, because I think it was in the Vietnam War, our kill rate had gone down so much, they felt the need to train better.
Amazing. Pete, this was awesome. Thanks for being with us.
Can you come back like in 3 days when we look at Cheermageddon?
Well, what we've got to talk about with Pete is the object's being shot out of the sky. I mean, Academy Securities is perfectly placed to have this conversation.
He probably has a
We have spent a lot of time on that.
I know you have. Peter, thank you. As always, Peter Cheer of Academy Securities. Futures right now, down 0.1% on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A warning from the Congressional Budget Office. It says the federal government would be at risk of a payment default as soon as July if Congress fails to raise a debt limit. House Republicans have threatened to hold off on lifting the debt ceiling until Democrats agree to cut future spending. China will impose fines on Lockheed Martin and Raytheon for selling weapons to Taiwan. The fines are worth twice the value of the company's weapon sales with contracts with Taiwan over the last 2.5 years. Lockheed Martin and Raytheon are also barred from exports and imports involving China. There is a report that Russia has lost at least half of its tanks since invasion of Ukraine almost a year ago. Now, that comes from the U.S.-based Institute for Strategic Studies. It says Russia is using older equipment as replacements. The FBI reportedly searched files at the University of Delaware, which houses President Biden's Senate papers. According to the Associated Press, the material that agents took does not appear to contain any classified documents. The president's legal team was said to cooperate with the FBI. And Fidelity is bucking the trend of financial industry firings. The Boston-based firm wants to fill about 4,000 jobs by mid-year. Fidelity says the new positions will focus on customer service and technology. That follows a year record hiring that brought Fidelity's headcount to 68,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
strikes. Bloomberg technology is there with the news and analysis you need. Every weekday, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Some of our Republican friends in the House are talking about taking the economy hostage over the full faith and credit of the United States. They say, unless I accept their economic plans, and which is totally irresponsible, they're not going to pay the national debt. Now, I made it clear in the State of the Union, I will not negotiate whether or not we pay our debt. I will not allow this nation to default.
That was the President of the United States on the big debt ceiling debate that's going to ramp up a little bit later this year. From New York City this morning, good morning to you. Equity futures down 0.2%. The equity market just a little bit softer, light to lower, negative, down just a touch. Yields come in a couple of basis points on a 10-year. Your yield right now 378.38, and your 2-year backing away from the highs of the year of yesterday. Your 2-year coming in 4 or 5 basis points through much of this morning. We're down about 4 basis points now to 4.59. Your next stop for this market about an hour and 13 minutes away, looking for jobless claims and potentially, Tom, another tick higher in claims for a second week, but still in and around 200K. That's a phenomenally low number.
Of a fully employed America, we've disinverted from negative 90 basis points in the shock yesterday of retail sales to negative 81 basis points as well. Public notice here, a number of people emailing, and thank you for watching and listening. Peter Scheer, John, I know you use this way more than me. MOSO is the major options screen on the Bloomberg. If you have a Bloomberg terminal, I don't think it works on your cell phone, but on the terminal, MOSO is this conduit into the Peter Scheer world.
I know I'll offend a lot of people by calling it like, watching the casino, the roulette wheel in real time.
Yeah,
I think I'm going to get a lot of hate mail.
He basically just said this.
I didn't mean that. Some people might say that that's what that has been.
This one take the lead and think this coming up.
That's how we described it.
No,
that's
exactly.
That's how we described it. That's
exactly
not my characterization.
I was in a McDonald's yesterday, and a guy came up to me in McDonald's. Thank you for watching. And he was talking about housing and rents and all that. And John, I went back and looked at rents in Manhattan. This is data off the Bloomberg, but I've done apples and oranges. From the beginning of the pandemic, Valentine's Day of 2020, rents have gone up 19% in New York City, 3,400, make it 3,500, up to 4,100. What's critical is to do some form of income approximation. In the same period, the income, the average income, not of fancy people watching Bloomberg surveillance, is up about 6.5%. And that delta, to me, is the only conversation.
It's not going to get it done. Tom, increasingly this city is becoming
12.5%.
very expensive to live in.
And I don't buy the
Too
idea
expensive.
it's better in Kansas City. It's different dynamics in Kansas City between rent movements and income movements, but it's the same angst across the nation.
It wasn't so long ago. I remember the banks would come out and they'd say, we're sending part of the bank to wherever it might be. And you'd be like, oh, you're getting sent away from New York City. That sounds terrible. Now all of a sudden everyone's like, you know what? Does the salary stay the same? What happens with the salary when I move? Because the cost there seems so much better.
Well, but that's the problem. And that speaks to what Tom's point is, that a lot of these places like Austin, Texas, for example, the prices now are sky high there as well.
Right.
But yes, to your point.
Isaac Boltansky joins us now with BTIG. I'm going to rip up the script here, Isaac, and I want to talk about your Ohio. There's a small chemical spill out in Ohio Ohio. It really is not on the elite East Coast radar. There's been a lot of criticism of that as well. Should we be paying more attention to train derailments in your Ohio?
Yeah, I think if you look at the actual data around train derailments, this happens a lot. And this is a regular occurrence. It's just that the actual impact that we're seeing in Ohio and the visuals are uniquely stunning. And this is something, Tom, that I think if we talk about trying to move from the rhetoric or the visuals of this event to what the actual policy discussion is going to be, Tom, what I'm hearing from folks on the Hill is, well, you know what? Pipelines are very often more safe than trains, especially when you talk about trains going through populated areas. So that's where you're going to see the policy conversation move.
To me, the elephant in the room, Isaac, is in the inflation data that we've covered in the last couple of days is housing in America. And I really take issue with the New York City conceit that it's terrible here, but it's fine out there. I just don't believe it for a minute. What can Washington do about rent and home ownership mortgage payment policy? What is the to-do?
You know, Tom, I spent a lot of time working on mortgage policy, especially with Fannie Mae, Freddie Mac, and FHA. And I think there's one thing that policymakers struggle with, which is our mortgage finance system is national, but our housing dynamics are all local. And so some of these pain points in certain cities that we've seen rapid growth in particular since the pandemic, there is no simple solution, right? There is an undeniable supply crisis. And there was an opportunity to address part of this with the most recent IRA bill. There was a discussion about sending money back to the states in the form of block grants and saying, we'll give you money if you do zoning reform, and trying to use that to spur growth, which we've seen in certain municipalities. But really, Tom, I'm afraid that from a federal side, all that we have is trying to turn the dial on demand even further. So there's talk of cutting pricing at the FHA, for example. And as you and I know, and you discussed before, this isn't a demand problem in housing. It's a supply problem. And so I am fearful about what that can do to marketplace dynamics, especially when the FHA, for example, is already seeing 6% early payment defaults. And you're starting to see some cracks in the data around credit performance in that asset.
You mentioned the IRA, and you do wonder about stimulus going forward, given the CBO report that we got yesterday and the upcoming fight that we're expecting. How did the report yesterday color your thinking about how the debt ceiling debate and potential debacle goes down?
Lisa, that one dropped like a lead balloon. I mean, the numbers in there were absolutely atrocious. There were, we have a $1.4 trillion deficit for this year. That's going to average $2 trillion per year through the 10-year budget window. We're going to see federal debt held by the public go from $25 trillion this year to $46 trillion in a decade. Not to mention, and this is the one that isn't getting nearly enough attention, the CBO says that the Highway Trust Fund, Social Security, and the Medical Trust Fund, the Hospital Insurance Trust Fund, are all going to be defunct in a decade. You wrap it all together and say that I am worried that DC isn't focused on some of the real drivers of our fiscal issues, which are entitlement spending and some of these longer term dynamics. Instead, we're going to have a fiscal fight over the debt ceiling, and it looks like that fight is now going to happen in the June to September timeline, with September probably being the date that most investors need to circle on their calendar.
So when people are in the market listening to this, is that basically that you're going to start to see T-bill rates shoot up violently short-term, like 3-month, 1-month T-bill rates?
Yeah, look, I think from a practical perspective, that's what we're going to see here as we hone in on that X date, when the government's extraordinary measures will be exhausted, which again, the CBO is saying will be between June and September. I'm telling you, I think that this Congress, no matter what, is going to punt that deadline to the end of September for 2 reasons. Number one, sequencing that aligns it with the federal funding deadline that is also at the end of September. Number two, no one likes to be in DC in August, especially lawmakers, so they'll want to push this fight into September. And so, yeah, Lisa, I think that that's what we're going to see as one of the downstream implications of this is pressure in the marketplace, especially in that time frame.
Isaac, see in September, because that's when everyone's going to start caring, because right now, Hardly anyone does. Isaac, we'll see before then. Of course we will. Isaac Voltansky there of BTIG on the latest. Here's the latest from HSBC. From staunch bears to lonely bulls. This from Max Kettner.
Oh, there we go.
I don't even scroll down to
Give the
find out.
history
It is
of
from
Max. Give the history of Max, though. It's important for our
So
viewers
Max
and
came
listeners.
into this year very underweight equities.
Yeah.
He was underweight through
Max
most of
Glow.
last year. Max underweight is what Max would say. And then he came into this year and he got more constructive quickly and pushed against the consensus that we would get this first half dip and second half rip. And he looked for performance in the first half. He said, we currently find ourselves as pretty lonely bulls in a crowded pack of bears. We think the Goldilocks backdrop is set to stay and answer the most frequently asked questions on our constructive view. The note goes on to do that. We are overweight equities versus DM sovereigns, overweight the Eurozone and EM equities, and so on and so forth.
He's catching up with Binky Chada and John Stolfus. Stolfus, I mean, you know, he was a little bit slow there. We covered that last year, and all of a sudden, Stolfus looks like a genius.
Well, he had a tough year last year.
He had a tough year last year.
He's having a better year
Unlike
this year.
Max, yeah.
Max had a decent year this last year and is having a decent year this year. Equity futures right now, down 0.2 on the S&P.
I'm having
More than that's
neither.
still to come. We try and have a better year together, Tom. Come by up, all that good stuff. All right?
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You'd go to a restaurant and order the soup.
Yeah.
You'd actually do that.
There are entire restaurants devoted to soup.
What, they, as a main course?
I mean, yes, of course.
Explain Soup Guy. Explain Soup Guy to the foreigner.
It's fantastic.
What's Soup Guy?
What
is this? What is this part of New York City I know nothing about? What's going
A
on?
Seinfeld episode where this guy was really mean and you had to be nice to him, otherwise he would say, "No soup for you."
I've never seen that. I've never seen that.
Well, now you have.
Okay. When my mum used to make soup for dinner, we'd be furious.
Really?
As children, without a doubt, we'd protest from the kitchen.
Maybe that's a
How dare
testament
you feed us soup?
to how good a cook she is, because when I make soup, my kids are very happy.
In a more sensitive time, they called him the Soup Nazi. That was like in the show.
Who's the soup in the show?
In the show.
They'd call the
In
guy
the
Soup
Seinfeld,
Nazi.
yeah. And literally, he was on a side street down in Midtown. I was down below 59th Street. I think it was 7 years ago.
That is amazing.
Yeah, things you learn every day here in America.
I just thought I'd continue the conversation from the commercial break into live programming, just so you all had a decent idea of what happens behind the scenes.
No, we
which
want a
is
big little ads.
Not a lot.
No, we're working on this for after the 4th of July. We're going to big little ads so you can see us in the break.
Like sports.
Like
I've said this
sports.
for ages.
Big
Like
little,
sports.
our wonderful advertisers.
As they're all sort of
board.
standing there singing and they shake hands and then the betting comes up on the other side.
Yeah.
Like, we can do that with zero DTE, latest options pricing.
MOSO.
All of that stuff. Whatever. Futures right now, down 0.25% on the S&P. We're a little bit softer, backing away from the gains of yesterday, both in the equity market and in the bond market as well. I'll keep this brief. The Nasdaq had a decent day of gains in the face of higher yields, and we're still trying to work out why. The 2-year yield looks a little something like this in the bond market. The 2-year backing away from close to 470 in yesterday's session. Lisa right now down 3 or 4 basis points to 459.32.
All right, let's take a look at some of the recent movers, in particular, some of the companies that have reported earnings. Roku, those shares were lower by something like 80% last year. They're up about 11.6% right now after delivering better than expected fourth quarter earnings. You don't understand
What
Roku,
is
I can
Roku?
tell.
Just
I
for
can
our
understand.
viewers and listeners, what is Roku?
It's so amazing. I can just look over, see your face.
No, what is Roku? I don't know what it is. I know what
box.
Apple is.
Well, it's that device that you can operate your streaming services on. And they have, basically, you can put in some sort of chip or some sort of device that then allows you to stream on any screen or on Roku-specific screens.
Okay.
So it's basically tied to the streaming wars. It did amazingly during the pandemic, then it was the post-pandemic hangover, and now it's basically growing. What we're seeing from Paramount, we were talking about Paramount earlier with Geeta Raghunathan, and it came out with earnings. They missed their earnings in the fourth quarter, and the shares are lower by 6.7%. But the interesting thing to me is they're not being rewarded at all for having record subscriber gains and better than expected subscriber gains. So right now it's all about the money, not necessarily subscriber numbers, which I think speaks to the moment that we're in. I also think that it's interesting to see Hyatt Hotels. They beat their expectations. Not surprisingly, those shares up just 0.4%. But John, this really speaks to what we've been talking about routinely. People want to travel. They are spending on travel, and the travel companies are delivering massive results as a result. And you're seeing this across the board, whether it's airlines or hotels.
Do you want quote of the day? Quote of the day from Oksana Aronoff from JP Morgan. This is great. Just pinged me a message. Bonds are back is all I hear everywhere. The last time this many influential people said something was going to be great was Fire Festival. Isn't that brilliant? I think that's absolutely brilliant.
She's trolling on the whole market.
TK's giving me the eyes like, what was Fire Festival?
That was
I'm
festival.
just not. Forget it. I'm not explaining it. If you don't get it, you don't get it. Like, I'm not explaining the joke. The line is right there.
Either does Deborah Cunningham not get it, Global Liquidity Markets CIO, Federated Hermes. She joins us today. Deborah, I've entered your world more in the last 7 days than I have in the last 7, 10, 12, 15 years. And you know, Deborah, you own it, the BTMM screen on the Bloomberg. Explain why the BTMM money market screen is so interesting now. Why are we so interested in short-term paper?
Well, if you look at 2022, Tom, it was really the only positive asset class, and expectations are that it's probably going to match, if not beat, most asset classes' returns in 2023. The products that we have in the liquidity space on that BTMM screen, if you call it as such, that are investing in commercial paper, treasury securities, short-term discount notes from government agencies, repo, they are yielding anywhere from 4.5% to 5% at this point, with the expectation that the Fed's going to go higher by another 25, 50 basis points. So their yields will continue to rise. So even if you look at bond yields getting up to 3.5%, 4%, with maybe a little appreciation for the year, you're probably not looking at much more of a return than 5.5%. You're kind of already guaranteed almost from a money market fund perspective.
Is your world running smoothly? Is the liquidity in the market, the fungibility, the back and forth of the short-term paper market healthy?
It is healthy. In fact, the short-term commercial paper market is at its peak in size in probably since post-pandemic or pre-pandemic. So it's almost 1.3 trillion at this point, and it's a healthy mix of financial firms, various industrial firms, different types of retailers. You've got pharmaceuticals in there, oil and gas making up a large part of it. So it's a diversified and growing sector of the market that has a lot of buyers at this point. So yes, the give and flow, two-way, buyers and sellers in that market are pretty healthy right now.
Deborah, I want to go to what Oksana Aronoff said, because not just about the Fire Festival, and I think it's a great line, but also it highlights this discomfort with everyone saying bonds are back. This is the place to be. It is incredible. What's the pushback, right? What's the potential risk developing when you get such a solid consensus?
Well, I think the concern is rates go too low, and therefore, the combination that I think with the bonds are back speak is a combination of what you can get from the coupon or the yield on the product, as well as maybe a little bit of potential, a little bit of potential growth from an NAV standpoint. So your total return, being up in the 4, 5, 6% area. The concern is if the yield gets too low, and that's the major component of that return, you're not going to get the overall total return that you expect. 2 years are really indicative of that. If you look at what 2 years have done over the course of the last month or so, they were way, way low following the bond sentiment market until, number one, the jobs report, number two, the Fed speak, number three, what we've seen strength and retailing perspective, economic statistics over the last week and a half, and now that 2-year yield looks more like it's following the Fed. It's not following what the bond market is saying. So that's the risk.
Yeah, to build on that, Deborah, one thing that I've been surprised about is everyone's saying they love cash. Everyone's been saying that the short-term debt looks incredibly attractive, and yet yields keep rising. How do you explain that? I mean, typically when people want more of it, prices go lower and the bond yield goes higher. Why are prices going lower if everyone's getting on the same trade?
Well, I really think it has to do with the Fed. The Fed has, really driven the front end of the curve, and it, prior to maybe a week and a half or so ago, was driving mostly 1 year and under yields with where the Fed was going. But now the 2-year has joined into that because people are realizing that what the Fed has said about going higher but staying there for longer is probably going to dictate market returns in 2023. So you can't bet that the Fed is going to get to a terminal rate, call it 1.25%, whatever you think it's going to be, and then start going back down and be back down at maybe 4.5% by the end of the year. That's just not what the market should be thinking, yet it was at the beginning of the year, and I think that's starting to erase. But that's what's driving yields higher, the Fed itself.
Deborah Cunningham, thank you for joining us on that Federated Hermes. That final point I think is really important. In fact, we heard the same thing from the ECB's Fabio Bonetta of the ECB Executive Board, essentially saying that, yes, we've slowed down, and yes, we're at that moment where we think we're getting sufficiently restrictive, but ultimately, we might have to stay around here for a while and figure out what's going to happen next. I keep going back to that note that Neil Kashkari wrote at the start of the year in his blog, when he said there's a second phase to this, and the second phase is we get up there quickly, and then we wait. And then we wait until we're convinced that we're going back towards 2%.
And there's now a new wrinkle to it, which is it might take them a little bit to get up to that place, right? It's not necessarily going to be 2 50 basis point rate hikes and then pause. It's they're more willing to go 25 basis point increments, but it doesn't mean they're going to raise any less than they would otherwise. And that's the point we're hearing from the ECB, as well as potentially the Federal Reserve.
If you find yourself taking longer and longer to explain your view of the world, it means your position is getting weaker. And I hear a lot of people who are bearish on the economy coming into 2023 spending more and more time needing to explain their position. And that starts with the January
That's
data.
normal.
The January data, it's retail sales. It's just a bounce back from what happened in December, because December was a fluke and this is a bit of a head fake. They don't believe in the jobs report, right? And claims and job openings don't capture the full picture, Lisa. There's something else going on here. And let's see what happens if we get another month of this data. How long will it take for that view to break down? Where you get to the point where you find yourself spending so long trying to explain your position that ultimately you can't even do it anymore.
But this is my question. How much does just the price action define the narrative? And how do you avoid that trap at a time when there's such little clarity?
Well, I don't think you can define the narrative by the price action right now.
Yes.
To your point, if you looked at bonds and looked at the economic data, I think that all makes sense to a lot of people. You look at where the leadership has come from with equities, I can't find the narrative that explains the leadership in equities together with what's happened with the data and what's happening in the bond market. That's tremendously difficult to do.
And I don't know if you can. And one thing that Peter Scheer said was that bonds are setting a much clearer signal at this point than stocks because of some of the, machinations in the derivative space that we were talking about, that perhaps it's just not very clear. At the same time, there is undeniable strength in the economy, and you have to factor that in a real sense.
I like Kettner's note this morning. You guys read it earlier and vamped off it. I just was reading it here, and I love at the bottom of his short note, John, where he says there are green shoots in earnings, and that is corporations adapting. And I'm going to go back, I sound like Michael Darda 101, to nominal GDP creates an interior animal spirit. The great Phil Carre, dead at 103, I think, expert on solar eclipses of Pioneer, used to say inflation and nominal GDP are bright lights that allow people to do better, to be malleable. You mentioned Hermes out, is it tomorrow?
Yeah.
Yeah, out tomorrow, along with LVMH this week as well. Granted, that's a little niche Dana Telsey area, but corporations are adapting.
Luxury and airlines performing so well. There's a massive China factor in all of that as well. We'll talk about those earnings tomorrow morning. Coming up, there's been a lot of people who thought maybe we'd get a pause in March from the Fed. Steve Englander was one, and he's made a change. We're going to catch up with Steve from Standard Chartered next. From New York City with futures down 0.25%. This is Bloomberg.
News from around the world. With the first word, I'm Lisa Mateo. China is questioning whether the U.S. is generally looking to repair ties damaged by the dispute over a balloon. The foreign ministry called on Washington to handle what it calls an unexpected, isolated incident. Later this week, the nation's top diplomats could meet at a security conference in Germany. Some new insight for investors on when the federal government will be at risk of a payments default. Congressional Budget Office estimates it could happen as soon as July if lawmakers fail to raise a debt limit. House Republicans want to hold off on lifting the debt ceiling until Democrats agree to spending cuts. Air India could almost double what already stands to be the biggest aircraft order in commercial aviation history. The carrier has ordered a record 470 planes from Airbus and Boeing. Air India now says it has options to buy another 370 jets. UK consumers are suffering from a cost of living squeeze, caused partly by soaring energy bills. Dale Vince, founder of renewable power supplier Ecotricity, discussed how the government can help ease the crisis.
During this crisis, our government has spent £100 billion subsidising energy bills just to take away some of that pain. That's dealing with the effect, not the cause of the problem. For the same sum of money, we could build all of the infrastructure we need to be 100% green on the grid in electricity and in gas, and that would be a proper investment for our country.
That was Dale Vince, who plans to sell Ecotricity. Earlier, we mistakenly said what he intends to do with the proceeds should the sale occur, and we regret that error. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England. And he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We've had three head fakes, right? We've had employment in January much stronger than most people surmised. We then had inflation come down less than people surmised. Now we have a boost to retail spending in January that's greater than people surmised. We don't think that the weakness in the dollar is over, in part because we see a more deeper recession coming in the U.S. and North America generally than we do in the rest of the world.
That was Terry Wiseman of Macquarie. Great to catch up with him yesterday, building on the story of the moment, which is strong economic data pushing the Fed to keep on lifting rates. Steve Englander of Standard Chartered dropping his call for a pause in March and saying the following: the Fed is likely to pause when there is a clear sign of labour market slowing. We now expect 25 basis point hikes in March and May, when they were looking for no hikes at all previously, and looking for a peak rate, Tom, at the Federal Reserve of 5.25.
Some of the adjustments here that we see, and with us in the studio now, we're going to get right to it. This conversation is so important, particularly after talking to Kenneth Rogoff here a few days ago. Stephen Englander joins us, Global Head of G10 FX Research at Standard Chartered. Do you remember back when you had your one-volume Mundell under your arm at Yale? I mean, did you read international economics cover to cover?
I did, but I think the textbook I used was even older.
Okay. Do those textbooks work right now in your analysis out of a pandemic with this unique inflation, unique international dynamics? Do the models, do the theories, do the textbooks work?
I think the basics are still very much in use. I think that the question of sort of how far ahead are consumers and businesses thinking is something that's been introduced since then. But you can understand 95% of what's said with the textbooks I used.
Ken Rogoff here 2 days ago talked about a 6% yield and that we're not framed out for moving of the 5-ish up a little bit higher, not to a Bullard. Bullard speaks today, right? 7% yield, but a 6% yield. What are the ramifications for our listeners and viewers if we enjoy a 5.89% 6-month T-bill?
Yeah, it depends on what's driving it. If it turns out that it's just that the U.S. economy is more resilient, but disinflation continues, which has been kind of what we've seen, it's a strong U.S. exceptionalism story. It means we can exist with higher real interest rates and the economy trucks on, makes U.S. assets very attractive. If it's inflation, it's like colossally risk off. It's still dollar positive in that world, but you kind of know that there's going to be a crash at the end and rates are going to come down.
In this really uncertain moment, with everybody just basically shrugging and not knowing, what's your compass?
You just have to look at the data, and I think that's why the January data were so tough. I mean, retail sales were very strong, but not seasonally adjusted. They drop 20% every year. The seasonal unemployment in January is 3 million. So you're waiting to see if those numbers are actually confirmed, apart from other issues that may exist with them. But, you know, I like looking at continuing claims. I think that's going to be sort of the indicator that ends up being the most reliable.
And we get continuing claims here in less than an hour, but at this point, we've seen them confirm the story that we've seen in JOLTS and also from the jobs data that we saw in January. So right now, what are the chances of the Fed going significantly further than the market is currently expecting?
Well, can I say yours on JOLTS? I mean, it's a sample of 20,000 firms and 30% respond. So, you know, it's a very thin needle that we're standing on. The other part, I think if you actually look at the numbers, you know, 2 month, 4 month, 6 month moving average, the services, you know, ex-housing is still continuing to go down. All the big core indicators were headed downwards. I mean, the disinflation story was not destroyed by the CPI. It was actually reaffirmed, but it was the Fed hawkishness that's kind of standing out in the market right now.
Andrew Hollenhorst over at Citigroup just put out a note where he basically said that the surprise has been resilient activity, which means that a recession is less likely, but it raises the probability of a more prolonged period of too high inflation. And they said now that the scenario of the Fed leaving Fed funds rates above the 525 to 550 rate, which is basically their base case, is growing, where they're going to have to go beyond that. Do you kind of agree, basically, because of some of the inflationary aspects, goods inflation reaccelerating in the car space, does that feed into a view that looks more probable to you as well?
Well, that's kind of our 2024 view. I think if the Fed takes interest rates up, Fed funds up to a 5 handle, the first cut or two doesn't bother them because they still know they're going to be tight. It's, you know, when the market says we're going to have a 3 handle in 2024, if you're not sure that inflation is actually getting close to target, it may be 2024 where the Fed disappoints. Is, you know, going from, you know, say they hit 525 and they go to 5 or 475, that's still, you know, pretty contractionary. Going to 375, they'd better be convinced that it's going to work.
I got to get Standard Charter on you with the great international reality of your bank day to day. We're going to have Damian Sassower join us in the next hour, and to get out front on that, thunderstruck at the deterioration I see in Argentina, 99% inflation in Buenos Aires. I got peso, black market nearing 400 peso per dollar. Help us with the immediacy for the International Monetary Fund. John is eagerly awaiting the spring meetings of the IMF. Can they even get there? Or does it look like bailouts for the IMF in March?
Well, you know, I think the higher that rates go, the more pressure there are on the weaker credits, and the more the IMF is going to have to do a lot of running very quickly in order to make sure that, you know, the sorts of default scenarios that people are speculating on don't happen. You know, it's a function of rates. I mean, we came in this year, risk premia were falling. Now they're rising. I mean, and I think there's some discussions between the IMF and other central banks and the Fed saying, we love you guys, but look at what you're doing to us.
Is Jerome Powell, as of, what was it, 6-month T-bill, 5%? Does that make him central banker to the world, to Nigeria, to Argentina, to the rest so troubled?
Look, the U.S. is 20% of world GDP and 150% of world financial market conditions because it gets exacerbated outside the U.S. So, he's more than central banker to the world. He's like king central banker to the world.
To be fair, though, the Federal Reserve started hiking a long time after the central banks started hiking, didn't they? How are those front loaders doing? Those that went early, went hard, went first?
Well, they did it because some of them could afford to do it. You know, you look at Mexico, you look at Brazil, you know, they have a rate cushion that's looking good. If you started off weak and you couldn't keep up, now, you know, you're facing the possibility that you're in real trouble.
If you had an ideal scenario where the Fed did set policy for the rest of the world, what would they be doing right now?
Probably kind of capping it. But again, they don't. I mean, that's
no, of course not. I'm trying to work out. I mean, we're sitting here saying, you know, the Fed's causing problems, but ultimately I'm looking around the world and they've all got inflation problems, haven't they?
Yeah, well, look, there's some of the inflation problems come because of domestic fiscal policy, because of domestic structural policies that they haven't addressed. It's not all on the Fed, but it looks like it because the Fed is the most dramatic thing that's happening over the last month.
That's the important point. I mean, before you go, Steve, I just wanted to wrap it up. It just feels like a really confusing time for a lot of people. Do you feel the same way? When I hear a Fed speaker or a Fed official, so to speak, and we caught up with one earlier this week, say things like we're data dependent, that just seems like the short way of saying I've got no idea. Is that where we are?
Well, to give them credit, I think they've raised enough that they're not sure where they are. But I think there's a possibility we're in 1981. There's a possibility we're in 1996. There's a whole range of possibilities that are out there with very different implications. And I'd say the probabilities that you would attach to them are not that different. So you have to wait and see how things play out.
It's perhaps unfair to say this, but I wonder if they're almost hoping not to get a repeat of the January payrolls report. Do you sense the same?
I think they light candles every day, hoping that they don't get a repeat.
That's the problem. It's it's real. There is this story, and, you know, I like the way you danced around Lisa's question. Lisa's very good question about job openings. It's like you question the actual data. It's no good. You know, push that over there. With payrolls, I think people are struggling to do that. You get a repeat of it in February, Lisa.
The payrolls response rate has dropped from 60% to less
So
than
we're going to do
45.
that with payrolls as well.
Well, no, but it's a real problem. You got to. The numbers have to be good.
I'm not saying it's not, but I go back to what I said earlier. It just seems to me that people are spending a lot more time explaining their position from the start of the year. And if you're spending more time explaining it, the position itself must be getting weaker, because if your argument is strong, it should be an easy story to tell.
To your point, the fact that San Francisco Fed put out an entire report about how weather affects employment numbers and how it was an incredible skew based on weather gives you a sense, right? And basically people are saying, oh, well, consumer spending's well because it's nice out, let's go shopping. I mean, it's basically, Sam Rowe put that out yesterday. I thought that was hilarious.
Look, to Steve's point, these are real issues. I'm not here to say they're not real issues. I just think that the January hard data has got everyone just sitting there thinking, I've got no idea really what's going on here. And I guess we're going to find out if we get a repeat in February. Too early to draw conclusions. Seen that line a few times over the last 24 hours. I'm getting a hard time on Twitter. Have you seen this?
Yes,
about the soup Nazi thing at Seinfeld? Yeah. I'm getting a hard time, and I deserve a hard time. Ferro doesn't know the Seinfeld soup Nazi, but then gets high-handed about Fire Festival week. I mean, that was deserved. That was deserved. I'm sorry, Tom. I'm sorry.
Thank you for that apology.
Steve, thank you, buddy. It's good to see you, mate.
Steven,
Wonderful as always. Just brilliant.
Thank you.
Steve Englander of Standard Chartered. Futures negative 0.25%. Live from New York City. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The market had gotten too far ahead of itself in pricing Fed rate cuts and not keeping up with where the Fed was.
It's still inflation, front and center.
We have seen disinflationary pressures begin to mount. The economy is flying. What I will say is it's possible that this recession is delayed.
In the next few months, you're going to start to see the U.S. economy weaken, and it's going to be in the context of a global economy that might actually continue to strengthen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, Tom Keene on radio, on television. Good news on inflation, sort of really good news on retail. Good news here in 29 minutes on claims. John, 4-week moving average claims. Never did I imagine this statistic. 189,000 jobs. That's stunning optimism.
It's just amazing, Tom. It's amazing. And let's see if we get another tick higher this week like we did last week, but ultimately still in and around 200K. Put it together with the unemployment data, Tom. Put it together with what we've seen in retail sales yesterday. And the hard data has forced a lot of people to reconsider how far this Fed might go.
The reality of the BTMM screen, 4.8, 4.9, 5%, even occasional prints here. Rogoff of Harvard out to 6%, and Bullard speaks today, who nudged 7%. Bullard's going to look prescient here if this keeps going.
A ton of Fed speak coming up a little bit later, but we have to keep going back to the lead story in the equity market. It's where the leadership is coming from against that backdrop in the United States. To see tech still leading, outperforming against the backdrop of high yields and better economic data, it's pretty phenomenal, fascinating to watch.
What do you think Ives will say?
Dan is going to say I was right. That's what Dan's going to say. Last year was tough, but I'm right. And look, the earnings weren't good, Tom, from these tech firms. They weren't that great. They really weren't.
I don't agree. I don't agree. I think their cash flows are stunning. I think their currency adjusted, some of them, was outstanding. Luke Mestra for Apple, single line in the middle of the press release nobody read. Ex-foreign exchange, it wasn't all that bad.
But it was expected, right? So this is the issue, is that they meet expectations.
I think you were correct.
Right, so this is the issue, to John's point, is they met expectations. They didn't exceed expectations. Everyone knows this. The change has been a dissonance right now, because typically those stocks do better when you expect a low-rate environment to persist. So is the stock market purely noise right now, to what we were hearing from Peter Scheer with some of the manipulations of certain derivative trades, and bonds sending a clear message that this is going to be a Federal Reserve that hikes more than people expect.
And look for Peter Scheer on Bloomberg Digital, folks. That was just a brilliant, brilliant dissertation, hugely valuable. But to the two of you, what I would suggest is, at the minimum, there's 3 markets. There's a speculation Peter Scheer market. There's 4 tech companies doing better than good, and everybody else, I mean, they're not in this NASDAQ rally. Am I right?
I don't think everyone is. What was it called? Lonely over at Max Kettner over at HSBC. It has been lonely. I've always struggled with the idea that the bond market knows something the equity market doesn't. I've always struggled with that. But this year it feels kind of odd. You can nail the bond market call. You could have said yields are going higher. We're going towards 470 again on a 2-year, and then totally failed on the equity market call.
Yeah, well, part of the problem is that we're seeing the economy do better and act more resiliently in the face of higher rates and tighter monetary policy than anyone could have predicted. And this is really the conundrum, is that, is the relationship breaking down a bit in order to see, okay, higher rates necessarily lower stock prices?
I got a great message moments ago. It said, hey, John, you should quote some predictions from average Joes to prove they know no less than these experts. So here's the quote. We feel there is limited upside after the recent rally and a correction is likely within the next 3 months. That's from Barry from Wildston. Barry, thank you. I'm going to do some more of this.
Can we get him?
It's like one of those talk-in shows, those call-in shows on radio or something. We've got to make that happen.
Barry,
We've got to do more of
for
that.
the 7B tomorrow.
Thank you, Barry. Let me know if you're free tomorrow, and we'll talk about this market. TK, just wonderful.
Absolutely historical. Let's go to the data. But, John, I'm going to say, I didn't have a chance to say this in the last hour. We're coming out of a pandemic. I stood on Fifth Avenue yesterday. The Bentley was stalled in traffic, and Mrs. Keene couldn't get to me in time.
Real average Joe moment, sure.
I watched Fifth Avenue, New York. It's not the same. It's all tourists. There's no employees. Work from home is in full place. It's not what we grew up with, and we're all living that coast to coast.
It's kind of weird.
Yeah.
It is kind of weird. Equity futures right now down a third of 1% on the S&P. As Lisa mentioned a few times this morning, we're 25 minutes away from jobless claims data in America. That jobless claims data has been phenomenally low. In the last couple of weeks, though, just last week, we did get a little tick higher. So look out for that. I don't think it's significant just yet, but if we get a trend, it's a trend. 200K on jobless claims is the estimate. 196, Tom, was the previous read on that number.
Right now, this is just perfectly timed. Daniel Morris, we visited with him in London on our last trip, Chief Market Strategist. We're scheduling something in London here coming up. Chief Market Strategist, BNP Paribas in London. Dan, I don't want to talk use of cash, share buybacks, dividend growth, and all that. I want to talk about what our viewers and listeners should do with their use of cash in their portfolio. What do you do with cash right now?
Well, I guess one big change compared to last year is you can look at fixed income as, I think, a much more attractive investment. We've had this massive repricing. Now, of course, we're talking about is Fed funds going to go up another 25 basis points, another perhaps even 50 basis points, perhaps. But we've already had the massive moves last year. So at this point, you're getting a decent coupon. And so I think that's an alternative that we haven't had, whereas on the equity side, what we're talking about are the risks, still the likelihood that you have a recession in the U.S. this year. That's not going to be good for equities. So that balance of risk reward, I think, is certainly favoring fixed income.
Dan, last year, everyone was a bond trader. They were a bond strategist. You had equity people coming on programs like this saying, look at the bond market. This is going to happen. This is why I don't like stocks. Dan, this year, they're looking at the bond market for signal, and it's not helping them. They're calling for high yields. They're getting them. And then at the same time, tech is outperforming. Dan, we've asked this question for weeks now. Why is tech outperforming as yields climb?
I think two things. So one, we'll have to see how long it persists. I mean, admittedly, it's already gone for several weeks. We've got to see if it can really keep the legs that it's had so far. I mean, there are some headwinds. But nonetheless, if you do go back to the recession call, which is also what we have, you do traditionally see growth outperform value. So at least on a relative basis, that actually is perfectly in line with what you've seen historically and what we would anticipate this year. So it gets us back to what happens with inflation, what does the Fed do, and how does growth respond? But over a slightly longer term view for the year, you do anticipate growth outperforming.
So does this basically mean that if you look past the recent hysteria, we're still in a clearly disinflationary phase and people are getting over their skis when it comes to expected rate hikes?
Well, I wouldn't go quite that far. I think we're, in retrospect, and easier to say always, but I think the big head fake, if you will, that we had with inflation expectations. I mean, at one point, the market was pricing the inflation rate at the end of the year at 2%, which was just a massive fall. But that was based on the data that we thought that we had, except subsequently the data was revised and what you thought was this big disinflationary trend went away. So I think that's another factor in how challenging these markets have been is you come up with a narrative that aligns with the data, but then the data changes.
So what do you do? I mean, basically, how are you positioning where it might be advantageous to be nimble, but also you're seeing pretty incredible rallies in the equity space and the risk space?
I think our response is to still be a bit cautious. We're overall neutral in our portfolios because you're right, you do see these big rallies, but you also see big reversals. So having conviction in a rally that is not only going to be big, but is going to be sustained, I think is really difficult right now. And we think the prudent thing to do is just to wait a bit longer. Let's get some confirmation of the trend from a few more data points that hopefully align in one direction, and then get on that train.
Dan, what would make you change your mind then? You said a few more data points. What would you be looking for?
Well, I think we either need to get confirmation, it comes down to inflation. Do we get back to this disinflationary trend, or do we see a plateau? Because I think the risk that we're starting to price in again, the way we did, frankly, at the end of last year, is that Fed funds goes to 5.5 or to 6. And if we do see a plateau in inflation, particularly around wages, that may well be necessary. But again, we've just had 1 month of this surprisingly strong data, payrolls and everything else. It's going to take more than that to convince the market and to convince us.
Hey, Dan, we've got to leave it there. It's great to catch up, as always. Dan Morris there of BNP Paribas Asset Management on this equity market, this bond market, the Fed, Tom, and just why tech is outperforming.
You know, when we do the bank earnings, and Lisa, major shot, I think he just killed the earnings season here with a cross-section away from what most of financial media does. I want to go back to Scott Galloway's great book, The Four. It was my book of the summer years ago, just magnificent must-read book for every student. The Galloway Four is modeled for $310 billion of free cash flow a year from now. I went out and looked at 4 Midwest war horses, Boeing, Deere, Cat, and a troubled 3M, and they're modeled out at $27 billion. 310 versus 27 is why everybody's focused on those 4 stocks, including Dan Ives.
I'm not saying they're not cash machines. They're cash machines. But, Tom, you've got to work out what multiple to put on some of these names.
Oh, yeah.
If growth is decelerating, and some of these companies are telling you that growth is decelerating, they're telling you that the good times of accelerating growth in cloud are coming to an end. They're now talking almost exclusively about AI to try and bid up their stock. We've seen that across some big names.
Exactly, and you already have really high valuations. And let's go to what Jim Bianco is saying. Yes, there are all these other companies that are doing incredible things aside from these 8 names, but those 8 names account for 60% of the total gains on the S&P 500 year to date.
And what's important there, to your point, John, is that Apple's got a 26 multiple off the Bloomberg DS screen. AI, by the way, that means Apple innovation.
Is that what it means?
That's what it means. That's what I'm getting you ahead of Ives here.
Is that what ChatGPT said?
Yeah. Who?
Nothing.
I can't even criticize you for not knowing. I'm
you
done. I'm getting
humbled?
slaughtered this morning. Slaughtered for not knowing the soup scene in Seinfeld. I'm just getting absolutely hammered. How can you trust this man? Where's he been?
He hasn't seen the soup Nazi. I mean, it is sort of.
Okay, but I don't get Doctor Who. Is it called Doctor Who?
Yeah, Doctor Who. That was a
I
British
have no
thing.
idea.
It just wasn't. It wasn't that big in the UK.
I'm on an airplane.
It just wasn't.
I remember this very clearly. Virgin Air. It's 2 a.m. The guy in front of me, I can't sleep because he's laughing so hard. I look over the fancy business thing, and he's watching this show called Little Britain.
Oh yeah,
and I was addicted to it.
Have you seen that?
And I didn't know a third of the. I didn't know a third of the humor.
That's great. That's brilliant. I missed that.
I had no idea.
I missed that. Futures right now down 0.4%. Jobless claims about 18 minutes or so away. Up next on the program, we'll catch up with Dan Ives of Wedbush on these big tech names.
Up to date with news from around the world. With the first word, I'm Lisa Mateo. A warning from the Congressional Budget Office. It says the federal government would be at risk of a payment default as soon as July if Congress fails to raise the debt limit. House Republicans have threatened to hold off on lifting the debt ceiling until Democrats agree to cut future spending. China will impose fines on Lockheed Martin and Raytheon for selling weapons to Taiwan. The fines are worth twice the value of the company's weapons sales contracts with Taiwan over the last 2.5 years. Lockheed Martin and Raytheon are also barred from exports and imports involving China. There's a report that Russia has lost at least half of its tanks since it invaded Ukraine almost a year ago. That comes from the U.S.-based Institute for Strategic Studies. It says Russia is using older equipment as replacements. A hedge fund star at BlackRock is raising $1 billion following his worst ever loss. Alistair Hibbard will reopen the BlackRock Strategic Equity Hedge Fund for more cash starting at the end of March. Hibbard's fund managed $7.6 billion at the end of last year. He lost 12% in 2022. And Fidelity is bucking the trend of financial industry firings. The Boston-based firm wants to fill about 4,000 jobs by mid-year. Fidelity says the new positions will focus on customer service and technology. That follows a year of record hiring that brought Fidelity's headcount to 68,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
What are the main problems in the supply chain? Well, it's a bit across the board, some systemic issues with the availability or the lack of availability of electronic components, chips, that is impacting a lot of suppliers. We've had the energy crisis situation impacting suppliers, a lot of difficulties to find skilled workforce around the world in the post-COVID environment.
The Airbus CEO just bringing it home there. The post-COVID environment, we're still in it. We're still in it, and we keep going back to it, Tom. It's year 3 of pandemic economics for so many of these multinational companies.
Yeah, full disclosure, I'm a big fan of him. I think he's just done a spectacular job there in managing the Toulouse message. I'm big on this, John. We're still in the pandemic. We're out of it. It's not as bad medically. You know, there's some huge moments of joy. But everything we're talking about every day is about the damage done and the move on from it.
Still working out the economics of it all. The post-pandemic labour market, what it all means. Is that labour supply, Lisa, going to come back?
Well, you've raised this point that where is the discussion around long COVID, around people who retired early, around people who died during the pandemic, all of these questions around the structural shift from this health crisis. But I'm going back to what Jim Bianco said, which is we're not going back to a 2019 economy. So what is the new post-pandemic normal? It will not look like the pre-pandemic normal that we were.
Do you know who we miss? Who we really miss?
Yes.
You know, not to put a downer on it, but you know where I'm going. The late great Alan Kruger.
Yeah.
You just know that he would have done some amazing research on what's happening in this labour market.
And to bring Alan Kruger up, this is towards Lyle Brainard. These are people doing applied economics, not theory, but actually what's going on out there. And that's, Card and Kruger clearly would have been there. Just because of time and his huge popularity, people lean forward on Global Wall Street. For the gentleman from Penn State, they threw him out of State College years ago. He asked too many curious questions. Dan Ives joins us now, equity analyst at Wedbush. Dan, I was talking about Scott Galloway and the 4 earlier. Let's call it the Ives 4. The 4 big companies a year from now, Bloomberg models $310 billion of free cash flow. What's the quality and the predictability, the persistency of the big 4's free cash flow?
Oh, I think right now we're looking 80, 90% visibility and more. I think that's the big difference to what even when you go back a few years ago. And that's what you've seen coming out of Cupertino. It's what's happening in Redmond and well as big tech. And I think that's been a big sort of headline during earnings, better than feared. And I think investors has underinvested in tech going into the years I've seen since 2009.
Should Tim Cook fear China?
I think ultimately he embraces China. I mean, look, Cook is able to navigate China as well as any CEO in the world. Understand that's the hearts and lungs of the supply chain, but also that's 20% of demand in terms of iPhones. And I can tell you, even as of this week, iPhone demand looks strong in China and globally. And that's really what I believe continues to move Apple higher.
Dan, last year we talked a lot about the interest rate sensitivity of the tech space. Are you saying that it's less interest rate sensitive now?
Look, I think the New York City cab driver at this point has sort of factored that into these stocks, at least going into earlier this year. I think now when you look, investors have sort of gotten used to it. They've factored that in terms of what the Fed's going to do. We're in the 8th, 9th inning. And now it just comes down to valuations relative to the last 5 years based on growth is as good as we've seen. That's why I think right now a lot of these tech names continue to move higher, because what we see with fundamentals, demand holding up, and you have all that baked into the stocks, which is why these stocks have moved up on lowered guidance and what I would say B-plus type earnings.
You said that people have gotten used to it. It's basically been baked in, and yet there has been a pretty marked shift in the market since the beginning of the year in terms of where the expectation for rates is, how far the Fed will have to go. At what point does it start to change the discussion around the feature in the tech shares that we've seen year to date?
Yeah, look, Lisa, it's a great question. I just think from a tech investor perspective, the CPI, PPI, white knuckle, print days, macro, I feel like a lot of that's in the rear view. I mean, investors understand you could have another 25 bip. Obviously, things can move around from a Fed perspective. But either way, light's at the end of the tunnel. And now we're starting to get to an investor environment where a soft landing or a no landing looks like what we're seeing across tech earnings.
Dan, I want to ask a question that we've gone over many times before, but it always bears review. Anurag Rana at Bloomberg Intelligence has a vision of where the cloud is going. What does the Ives cloud look like 5 or dare I say 10 years out? These big tech juggernauts, do they have degrees of freedom to move larger in revenue, larger in market share, larger in global footprint, I should say?
They do. Look, I think right now, when you think about moving to the cloud, only 45% of workloads move to the cloud. And I think that when I look at the vision, it's really going to be about artificial intelligence and about that data. And that's why you're seeing this Game of Thrones play out between Microsoft, which was top of the race, Google, obviously the debacle last week. But you're going to see Amazon, you're going to see Apple and others dive into the deep end of the pool, because that's going to be an $800 billion market in a minimum that we see over the next 5 to 6 years.
I looked in, I walked by the Apple store yesterday on 5th Avenue, and I pointed to Mrs. Keene where I stood on the sidewalk with the wonderful Lawrence Haverty, Larry Haverty, who taught us all how to do securities analysis on these tech companies. And he and I did a stand-up interview a decade ago, 12 years ago, 13 years ago, over the death of Apple. Is that gloom still out there?
I think it's the same that said Mahomes was never going to win another Super Bowl. I think you just continue to ultimately have an install base that's increasing. They're gaining share in China, and now you have 1.2 billion iPhones worldwide. You had 975 million 18 months ago. And which is why, in my opinion, this is a Rock of Gibraltar tech stock. Haters will continue to hate, but I think, again, it will be a $3 trillion market cap.
So we talked last year a lot about the winners and the losers of the tech space and that there would be bifurcation, and yet it seems like there isn't bifurcation and that story is basically gone out the window. What do you make of that? The fact that Apple's being lumped in again with Meta or Facebook?
Look, I think what you're starting to see is the headcount cuts, and you've seen that with Zuckerberg and what Meta's done. That's really, along with activism, put a bottom on a lot of these stocks in terms of, and now you're going to start to see, I think over the next 6 to 9 months, more of a deviation, at least fundamental, between winners and losers. But the one thing I'd point out is that any of the frothy names that continues to get sold off, you have significant M&A dry powder, both financial and strategic, as well as activists that are going to swirl across the board. Salesforce is a perfect example. You have, so many that hate it. If you go back 45 days ago and now, I think there's a stock that has significant upside because of activism and because of ultimately numbers better than feared.
Are we now comparing Mahomes to Apple? Is that what we're doing now, Dan?
Look, I think for Apple, you got to start to go to Montana level or Brady.
Yeah, Mahomes, Dan Mahomes is a quarterback for Kansas City, in case you didn't.
I was just making a clarification.
Not yet. Mahomes, clear Hall of Famer. But look, in terms of what Cook and Cupertino have done, Tom Brady-like again.
That's better, Dan. That's better. Mahomes didn't hit in quite the same way. Dan Ives of Wedbush. Dan, thank you. You can't compare Mahomes to Apple. I mean, come on.
Are you basically provoking the people who are getting on your case about the Soup Nazi episode of Seinfeld? They probably are Chiefs fans. They're going to come after you with pitchforks. That's all
a hard time today, aren't I? Okay. Mike McKee's going to drop by in about 5 minutes. He's going to talk about jobless claims. Michelle Ma's going to drop by too from MasterCard.
Oh, great.
MasterCard card data is really interesting. If you look at some of the spending data for January, that would give you a decent lead on what's happening with retail sales. But Tom, just to go back to tech, the year-to-date gains are just phenomenal. They're just phenomenal.
You guys, when we're doing this, we're all working in real time, and Lisa makes me smarter right now. Facebook is up 80% since the Ancampora bottom in October. Is that true?
It's shocking.
I would have never guessed that.
But this is my point. It's that you've seen the biggest 80%. Rallies in the least profitable companies.
Terrible. They're going out of
really
business.
One of the questions that I have here.
It was the spending. They were spending too much. You got to October.
So they're acting like adults.
They even changed the name, for goodness sake, to something they were wasting money on at the time, and maybe it will turn out not to be a waste of money. But the return of efficiency to that company, Lisa, that's where the effort is now for 23.
Do they change their name back to Facebook?
I've got no idea. Would that help the stock rally?
After that Super Bowl ad for Gorman?
Maybe.
The guy's going, I'm living in the metaverse, and the baby goes, I don't get it.
Jobless claims up next in America from New York. This is Bloomberg Surveillance.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Surveillance, we welcome you here. What a set of data points we have seen. We're going to get further clarity here. We're going to do this with Farmer McKee's. You know, I'm old McKee had a farm.
Farmer
PPI-IO or whatever. PPI is not CPI, but it matters. And there's also a small matter of housing starts in jobless claims. We'll let Mr. McKee tell you which matters. Michael?
Well, let's get the numbers and then we'll figure it out. They're just coming in now. PPI for final demand, a real change from December. For January, the headline number comes in up 0.7%. January revised down to a negative 0.4%. So a 1.1% swing there in PPI for final demand. Take out food and energy, it's still up 0.5%. And on a year-over-year basis, up 6%. Food and energy core up 5.4%. Those are both lower than we had seen in the prior month, but they're still a very high number. Housing starts come in at 1,309,000 annual rate. That's down 4.5%. They were down 1.4% in December. A bit of a surprise. There had been a thought they might go up because weather was better in January. Building permits up 0.1%. Jobless claims. What do you say about jobless claims? 194,000. And last week was revised to 195, so only a tick lower. Let's put it this way. The labor market's hanging in there.
Well, everything is hanging in there.
Finally, we got the Philadelphia Fed index takes a dive, negative 24.3 after a negative 8.9 in December, and I can't tell you what that's about, but I can tell you.
Oh, come on. It's about the Eagles.
Well, that is probably true, Tom. The prices paid index for the Philadelphia Fed is 26.5 versus 24.5. So that's gone up a little bit. So,
We'll let you dig through the numbers. Dig through the numbers while we try to figure out what's going on. There is a turn to the market, which actually, Tom, I'm surprised about, because what the clear conclusion here is PPI, the disinflation that people were talking about in the goods sector, isn't as great as people thought. In fact, this disinflation is really mild. It is not coming down nearly as fast as people expected. Let me give you an example. PPI final demand was expected to come in year over year at 5.4%. It came in at 6%. A decline only of 20 basis points. The revision upward dramatically in the prior month. Again, one data point after another, hotter than expected.
Market catching up with Michael McKee. VIX up a stick right now, 19.15. Deterioration, S&P 500, negative 31 basis points. We do get some inversion in the yield curve, the dynamics of the full faith and credit from negative 80 points to negative 82 basis points. a greater inversion with fractional dollar weakness. I'm not getting much love from the actual 2s and 10s, Lisa. But to your point, PPI is a set of data with revision is a higher inflation regime for business.
This, to me, really is the main takeaway, that inflation is still very high relative to where people had expected it to be, and it hasn't been coming down as quickly. The labor market's still strong. Anyone looking for coincidental data is really getting the same clear message. So is this enough, Michael McKee, to say people underestimated the strength, underestimated the resilience, and that disinflation isn't happening nearly as much as people expected a month ago?
Well, it's not happening as fast as people expected. And I think that was the big takeaway from the numbers that we've gotten this week. People thought, given what we saw in November and December, that prices would come down very quickly. They're coming down, but not very quickly. Goods prices, remember the story was that goods prices were going away and services were the issue. 1.2% rise in goods prices in the PPI for final demand during the month of January, and services only up 0.4%. So the opposite of what we were looking for. And I got to mention the PPI for trade services, which is basically, they calculated from the margins of retailers and wholesalers up only 0.2% after 0.8 the prior month. So what we're seeing is a compression in margins. And there's a story on the Bloomberg today about how in the past that's usually led to layoffs, which is not happening this time.
We got to get to Michelle Meyer with her wonderful view on the consumer. But Mike, I've got to ask you about the Fed speak today. Professor Rogoff sat in your chair 2 days ago and began to model out 6% yield structure. Bullard, who speaks today, shocked us with a 7% what if out a ways. Are we shifting up now? Are we going from a low 5-ish up to a higher view or guesstimate out?
Well, right now, the consensus seems to be they're going to get to 5.5. Now, that was yesterday before today's numbers come in strong, although that Philly Fed is an outlier. The issue is we still have a lot of data between now and March 22nd. So a lot of opportunities for people in the markets to either price higher or change their minds.
Much more from Michael McKee through the morning. He'll dive into this wide set of data. This is a joy. Michelle Meyer, I was discovered with her expertise on the consumer and housing a number of years ago. She had a sterling career with Global Wall Street and now gives us an information knowledge with her economics that you can only get at MasterCard, with the MasterCard Economics Institute. Chief U.S. consumer expert Michelle Meyer joins us this morning. Michelle, you get the data like no other market economist in the game. What is the state of the American consumer?
Yeah, Tom. So we are absolutely looking at the consumer with a high level of detail. And what we're seeing and what we have been seeing for a while is that the consumer is out there able and willing to spend. And this speaks to the inflation data. It speaks to the labor market data, that the consumer still has purchasing power, right? You have a labor market that's still expanding. Income growth is out there, aggregate income growth in particular. There's still some savings buffer, and there's still access to expand the balance sheet. So to underestimate the U.S. consumer has been, has been a problem.
Without getting into the Vatican secrets, are you seeing massive credit card usage, and how do the higher interest rates of credit cards fold into your optimism on the consumer?
Look, what we're saying about the consumer is that they are using all of their sources of purchasing power. And the good news is that they still have a lot of purchasing power coming from the labor market, from job creation. So at the moment, you still have a lot of income flowing in, a disposable income, which is supporting that spending in real time. So consumers don't necessarily have to rely as much on other sources. It's not as though the consumer is strained right now. They're doing a really good job being able to navigate what has been, for the last year, some pretty high prices. And that is what fueled the inflationary numbers that we had seen all throughout last year. But yes, the consumer, of course, has utilized savings. The consumer, of course, has increased credit card usage as well. You've seen, from the Federal Reserve G19 data, revolving credit outstanding has been on the rise after the post-pandemic period where consumers paid down their debt.
Michelle, I'm looking right now. We just got a number of data points from the United States government, and the markets are slow to respond, but they are starting to respond a bit more. You're seeing the NASDAQ down now, near session lows, around down 1% ahead of the open. Do you get the sense that people have bought into the disinflation story too much, that we could see even another bout of reinflation that sends CPI even higher?
So to me, a useful way of looking at inflation is to understand the different drivers of inflation. So the good news on the disinflationary storyline is that the supply side has really come back, right? You've seen this repair of supply chains. You've seen the restocking of retailers. So inventory levels are back to normal, and retailers have been able to return to just-in-time inventories, which makes pricing much easier, much more transparent. And during the holiday season, we did see consumers enjoy a lot more promotions and discounts. So on the good side of the equation, I do think there is a disinflationary story. For services, which is going to be more tied, particularly this super core, which takes out housing, it's going to be more tied to the labor market. And there we know there's still some wage pressure. We know there's still a lot more stickiness. So that's just going to take time. So I do think it's really important when you're looking at inflation is to be able to separate the different parts of the inflation narrative based off of those drivers of inflation. So I don't think the disinflationary story is over, but we have to be aware that it's going to take time.
So what's your sense of where the market is wrong? I'm looking right now at two-year break-evens that are close to 2.9%, that in 2 years from now, you're going to get a 3% essentially inflation rate. Is that bang in line with your expectations based on the consumer spending and the consumer spending power that you see in the granular data?
I think over that time frame, that does seem pretty reasonable. Because if you think about the core goods components, prior to the pandemic, those were deflationary components. They were seeing price reductions. And then you had this dramatic increase in the level of prices, which does not seem sustainable. So a mean reversion back to more normal levels or more of a disinflationary tendency for those categories seems right. And the labor market, we know, was not going to be able to continue at this rate forever. And the Fed is committed to cooling down the labor market. So if you believe in the Fed's resolve, which I think we should, and they're communicating that we should, then yes, inflation should ultimately come down. It's just going to take time. This whole cycle is taking time, and that's what we have to remember.
Michelle Meyer, it's been too long. Thank you so much. MasterCard Economics with us this morning. McKee working feverishly here. He's on page 42 of today's economic data. What was on page 27?
Well, Tom, what we're looking at here, I went to the Philadelphia Fed because that's the outlier for the day. Everything else suggests some strength. You could make a marginal case for housing starts, but the headline Philadelphia Fed is negative 24.3 after negative 8.9, and we see new orders drop to negative 13.6. Delivery times got longer, negative 13.6. Inventories rise. Number of employees is cut in half. So at this point, whatever's happening in that Philadelphia, New Jersey region doesn't seem to match what's happening in other parts of the country. And it does look like companies are raising prices in order to meet the demand that's out there overall.
Yeah, to your point, New York Fed Services business activity came in less bad than people expected. So it's definitely region by region. Just real quick here, are people starting to question the data more that you speak with?
No, I don't think they're questioning the data more, but they're questioning the models that underpin it in the sense that this is not what you are expecting to see. In defense of Federal Reserve officials, they've been saying we're going to see a stickier inflation problem here, and we're going to see below trend growth. So they've been 50% right on that.
We'll continue here with Michael McKee. Lots of good information there as well. VIX out of stick, 19.32. SPX deteriorates negative 30 to negative 36 on the Standard & Poor's 500. Two-year yield fractionally higher. Stay with us from New York. This is Bloomberg Surveillance. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is questioning whether the U.S. is genuinely looking to repair ties damaged by the dispute over a balloon. The foreign ministry called on Washington to handle what it calls an unexpected, isolated incident. Later this week, the nation's top diplomats could meet at a security conference in Germany. Some new insight for investors on when the federal government will be at risk for a payments default. The Congressional Budget Office estimates it could happen as soon as July if lawmakers fail to raise the debt limit. House Republicans want to hold off on lifting the debt ceiling until Democrats agree to spending cuts. The FBI reportedly searched files at the University of Delaware, which houses President Biden's Senate papers. According to the Associated Press, the material that agents took does not appear to contain any classified documents. The president's legal team was said to cooperate with the FBI. In New York City, Mayor Eric Adams is reconsidering his requirement that city employees work in the office 5 days a week. The problem is that city jobs are going unfilled as more flexible work can be a bit more appealing. Air India could almost double what already stands to be the biggest aircraft order in commercial aviation history. The carrier has ordered a record 470 planes from Airbus and Boeing. Air India now says it has options to buy another 370 jets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
The higher that rates go, the more pressure there are on the weaker credits, and the more the IMF is going to have to do a lot of running very quickly in order to make sure that, you know, the sorts of default scenarios that people are speculating on don't happen. I think there's some discussions between the IMF and other central banks and the Fed saying, we love you guys, but look at what you're doing to us.
Stephen Angleter, brilliant there on the IMF. We're going to get to that in a moment here. This is what Bloomberg surveillance is all about. Tape deterioration, -43, down a stick on the S&P 500. NASDAQ deteriorates down 1.3%. VIX out nicely, maybe to threaten 20 here in a moment. Here's the agenda for the next 20 minutes for Global Wall Street. Lisa Bramlett and Tom Keene with Michael McKee on important headlines from the mathematician from Cleveland. And then he's recovered. He was in recovery off Eagles loss. Damian Sassower here on serious issues in the land of IMF. We're going to talk about that in a moment. Mr. McKee, go.
Yeah, she is making some news. Loretta Mester, the president of the Cleveland Fed, bringing the 50 word into the conversation, saying that she saw a compelling case on February 1st to raise the Fed funds rate by 50 basis points instead of the 25 that they did. One would assume that she would carry that belief over into the March 22nd numbers, especially considering the PPI we got today. She doesn't think we're going to get back to 2% inflation until 2025, and wages are a primary reason. They're a percentage point to a percentage and a half above a sustainable level, so wages have to come down. She's also suggesting, however, that she sees extreme weakness in the economy ahead, and many of her contacts in her district are preparing for recession. Now, if only that showed up in the numbers. If she were Pat Harker, then that might explain the Philadelphia Fed numbers. But right now, the rest of the country seems to be moving along fairly well. Jobless claims 194.
S&P negative 46 here. Lisa Bramlett and I are going to have a conversation. We're going to drag McKee into this because of his experience on 1998 and various and Sunday IMF moments. I've been wanting 3 days to speak to Damien Sassower. He is truly expert in EM credit strategy. A Bloomberg article saying now's the time. I looked at Argentina, Buenos Aires inflation 99%, black market pesos 373, according to Bloomberg News. How close are we to where Georgieva of the IMF has to bail out Argentina, Nigeria, and Sassower land?
Well, I think we're in actually a little bit of a better place relative to where we were just, 3-4 months ago. I mean, let's be clear, Tom, recoveries have improved. The IMF has done a pretty good job. I mean, they've kind of dropped their heels with Tunisia a little bit, but, for the most part, they've done a good job at just improving the playing ground. But my goodness, the move we've seen in credit default swaps, so implied default probabilities out along the perimeter for the most distressed economies in emerging markets, I'm talking Ghana, El Salvador, Ecuador, well, maybe not Ecuador and Ghana, but the others, have all come crashing down. I'm talking like 60, 50% declines in default probabilities, because if you imply what the default probability is from the market price for the credit default swap itself, it tells you that it's down pretty considerably. Right now, there are only 6 emerging markets that have a 1-year implied default probability of 10% or more, which is better than where we were, but it's still pretty bad.
I'm sitting here, I'm distracted by the tape, because what we're seeing right now, the deterioration is notable. You're seeing a 1.5% decline in the NASDAQ on the heels of the data, and then the Fed Mester headlines added to that. But then 2-year yields also surging to new 2023 highs at 4.7%, nearly 4.67%. How much has the entire EM trade and the willingness to extend money to a lot of these developing nations really entirely been predicated on the risk-on rally that we've seen so far this year?
Well, we got to take a step back. We have to talk about which EM asset class we're talking about, because EM sovereign credit, I'm talking emerging markets who have to fund in dollars. I mean, we've seen tons of demand. Investors have been adding to longs there for the better part of the last 3 months. In EM local debt, we're only just starting to scratch the surface of foreigners going back into those markets, places like Mexico, Indonesia. You're actually seeing the buying stalling right now, Mester and everybody's saying. But then if you look at EM currencies, that was a huge short covering rally, right? And that's kind of done now.
It's the short covering is done, and then the now what is important. Let's go to Michael McKee on this. You and I read Stanley Fischer, that little red book that came out after 1998, cover to cover. I mean, we've been here before. What's different this time about the IMF versus other moments of rising rates folding into fiscal realities for nations?
Well, obviously they have gotten better at surveillance, so to speak.
Nailed that.
Come back. In keeping track of what's going on in emerging markets, and especially their current account balances. And they have urged countries to build up those balances, which they have done, which makes things a little bit better. There's more transparency, there's more information out there, so people can react more quickly. One of the big changes, too, I think, and Damien will know this, is the Washington consensus has sort of gone away. The idea that what you do is you jack interest rates up when your currency starts to fall. And now there's much more of an individualized view of how to keep these countries' heads above water.
S&P futures deteriorate -47. And Lisa, there's the Bloomberg headline on the 10-year yield, highest since the beginning of the year, 3.84%.
You've seen a similar move in the 2-year yield. You've seen dollar strength, euro weakness, 106.77. Basically, a percolating risk-off feel as people realize that the data highlights it's a persistency to the inflation that really calls into question how quick this disinflationary process will be. And Damien, I do wonder, we've talked a lot about the effect of China's reopening. We've talked about it with respect to the developing world. How much is that part of what's underpinning this, that there has been greater demand and less of a deterioration than we otherwise would have gotten?
Lisa, you have taken me right to where I want to go this time. I mean, the correlation between emerging market credit default swaps and China CDS is as high as I've seen it in years. And I mean, I'm talking 91% correlated between China 5-year CDS and EM CDX. I'm talking there are 6, maybe even 7 or 8 individual countries whose correlations to China CDS are now 80, 90% plus. Wow. So that means China is driving the entire complex. Sorry about that. And then the other thing I'd probably say about it is what is the more growth story? I think it's a China reopening story. I think that has greater durability for foreign exchange managers. And so from my perspective, I think you probably want to play those themes. I'm talking Aussie dollar. I'm talking the Andean region.
So you're saying this is an EM opportunity given the rate regime of Mr. Powell and the rest?
It's always an opportunity in emerging markets. It's all in the eye of the beholder. Do you want to fund in dollars? Do you want to fund in yen? I personally think you probably do want to fund in the low yielders. I think the carry trade is back on in emerging markets.
When do I buy 4,000 square feet in Buenos Aires? I mean, the wealth devaluation in these nations is shocking.
It's shocking. I mean, but the wealth, I'll tell you where the wealth devaluation isn't. It's in Bermuda. I was in Bermuda just last week, meeting with clients there, talking to the reinsurance capital of the world and those who allocate money out and run, you know.
What'd you learn quick?
I'll tell you really quick what I learned. They have a lot of exposure to U.S. housing and U.S. banks. A lot of exposure. So let's be careful.
Before we really close out, as we head into the market opening, the U.S. Markets, I'm curious, as you parse through the data, Mike, is the takeaway different than the initial read? Because it seems like this market is responding more aggressively now.
I think it's exactly the initial read. People are looking at these numbers for producer prices and folding them in to the CPI that we got and folding them into the economic strength that we got and thinking, well, the Fed is going to have to go higher for longer. And then you have Loretta Mester backing it up saying, well, we could have done 50 the last time.
1-2 punch.
So maybe we're going to do it again. Okay. The interesting thing is the Fed has said all along we're going to need to go over 5% and do more. This is just kind of the market catching up to what Fed officials thought.
Can we do this again, guys? Are you on speaking terms? I don't even know.
No one responded.
Damien Sasso or Michael McKee, you and me, Damien Sasso and Michael McKee, thank you so much. Folks, this is what it's about, the intellectual firepower here. Totally. On fire. Futures at -45. They deteriorate from about -32 down a stick. NASDAQ down 1.4%. And John, I sound like John Farrell. What's that about? Dow futures -272. And the VIX getting out near a 20 level. We have a reinversion. Let me explain this quickly. It's what the adults look at. -90 beeps. We had less inversion, less angst to -80, and we come halfway back now to -84 basis points. So that's the at least I guess whipsaw is sort of like the word of this FOMO Thursday.
Yeah, it's been a whipsaw, but today it seems like it's less of a whipsaw. It was more conclusive as people parse through this data. There is this issue that Mike McKee brought up, which is fascinating, that this is what the Fed's been saying. This is their own projections, and this is the market catching up as the data reveals a reality that perhaps was a bit different than what people were expecting.
Please stay with us on Bloomberg Radio and Bloomberg Television through the day. The Chief Executive Officer of Generous Motors, Mary Barrow, will be with us. I believe that's in the 3 p.m. hour in New York. Yes, 3 p.m. In New York, and we're going to get right to the markets on a move now off of really, really interesting data. I would accentuate business inflation, a little more inflatey. Thanks so much for watching. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne-Bonn airport, designing it around key strategic goals.
what I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. 3 ingredients: an upside surprise on PPI, a downside surprise on jobless claims. Throw in a little bit of hawkish Fed speak and you get a recipe for this. Equity futures down and down hard. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, resilient economic data keeping bond yields elevated. Tech outperforming this year in the face of higher rates as President Biden and Tesla's Elon Musk make nice. We begin with the big issue: gloomy economic predictions taking a beating.
Look at all of the data.
The extremely strong data.
The U.S. consumer is very strong.
The jobs market is still very, very strong.
The economic data seems to be more resilient.
The market's just waiting for the data to fall apart.
Nothing ever happens in a straight line.
That's why we're moving from, hard landing, soft landing, no landing.
Growth and inflation are going to be higher than what was expected a month or two ago.
If you were in the camp of a Fed pause, you're definitely disappointed.
The Fed's going to have to be a little bit more aggressive.
This, to me, signals that we're not done yet.
Inflation is still too high.
It's going to be tough to get inflation down.
Chair Powell essentially is telling us they're data dependent.
Odds of rate cuts for us are off the table for end of this year.
The tightening cycle has a little bit more room to go.
Mike McKee joins us now for more. Hey, Mike.
John, a data dump this morning that really confuses the markets. It kind of tells us that the economy is stronger and inflation stickier than we have thought, or at least it backs up the data we've already gotten this week on that. PPI for final demand comes in up 0.7%. The trade services number, which I'll talk about in just a second, only up 0.2%, and that's important. Housing starts down 4.5%, kind of a surprise because the weather was bad in December. It was supposed to be better in January. Building permits up only 0.1%. But here's the number John was talking about, 194 in terms of jobless claims. Still no sign that companies are getting rid of people. And our outlier of the day, the Philadelphia Fed, comes in negative 24.3. Employment slipped and new orders slipped. slipped, and jobs were cut in half in terms of the outlook there. So that is your one sign of strength in the economy, or a weakness in the economy overall. Now, the reason I mentioned the trade services are a combination of the margins for retailers and wholesalers. And normally when margins are going down, you are seeing companies lay people off. And in this case, that's not happening. I'm using the unemployment rate as a proxy for jobless claims because it's hard to do jobless claims with the numbers in 2020. But you can see that we're seeing an issue there. Now, you've got this from Loretta Mester that has made a big difference to the markets this morning. She thinks that they could have gone 50 or should have gone 50 at the February 1st meeting, which puts that into the conversation now for March 22nd. She's not a voter, but people will be talking about, well, are they going to do 50? Because we're seeing these high inflation prints. And the interesting thing about all of this, John, is that if you go back to the Fed dot plot from December, there were the majority at 5%, 5.1% was what the belief was for 2023 for the Fed funds rate. But there were 7 members, only 2 short of being a majority, who thought they would go above 5%. So basically the market is catching up to the Fed right now. The Fed has been predicting this as a possibility all along.
Mike McKee, thank you, sir. A lot to chew over. JP Morgan's Kelsey Barrow joins us now alongside BlackRock's Jean Bavin. Kelsey, wonderful to have you with us. Let's start with you and go through this piece by piece. Unemployment at 3.4%. Retail sales just printed 3% yesterday, 3 handle. Claims just around 200K. Upside surprise on PPI. What do you say to this?
Well, the facts are coming in, and the facts are telling us that the U.S. economy is more resilient. And so the Fed is highly data dependent at this point. And so when the data comes in stronger than expected, you see these strong market reactions. And that's exactly what we're seeing today.
Jean Bavin, your thoughts on it as well? Just upside surprise after upside surprise on a hard data. It's pretty impressive stuff.
Yeah, I think, we've seen a growing disconnect appearing over the last few weeks since January. I think that is now being resolved. The disconnect was between the Fed and the markets. That gap is closing quickly. I think the massive change we've seen was a shift from hopes that inflation would resolve itself in a straight line to 2%. And those hopes have been dashed with like the last 2 weeks of data, which have made pretty clear that, first of all, inflation didn't fall as much as we thought. Second, it's going to be more persistent than was expected. And third, the labor market is so tight that it's very, very difficult to expect that to resolve on its own.
John, you and I have talked about this before. You've said recession foretold. Are you still pushing that recession call in the face of this?
Well, I think, first of all, the key thing here is that the lens on the data, the activity data, has to be, shifting. If you are starting from the point of view that inflation will not fall on its own to 2%, then I believe that strong data on activity coming in is bad news for markets because it's going to mean more hawkish central banks than what they're expecting. And I think they'll have to do more as a result. The stronger we are seeing the near term, the more they will have to do. The reality is the recession might be, farther on the horizon than we would have thought, but I still think we're going to see a very significant, slowdown. You can debate about whether it's recession or not, but it's still more than the market is currently discounting.
Well, let's talk about what it means for the Fed. Loretta Mester of the Cleveland Fed speaking moments ago. Mike McKee touched on that. Here's the quote from her just moments ago. At our meeting 2 weeks ago, setting aside what financial market participants expected us to do, I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%. Kelsey, in your mind right now, based on the incoming information, how far do you think this Fed's going to push it?
Well, the Fed has more work to do. We do expect at least 2 more 25 basis point rate hikes. And, the view on this has evolved, and particularly because of the backward revisions to CPI and payrolls, which, we don't really focus on revisions very much, but they really change the landscape in terms of how much progress the Fed has made. So they have made progress. We don't want to lose sight of the fact that they have hiked. 450 basis points, which is an extremely aggressive pace, especially considering at the beginning of 2022, they were actually still doing QE. But at the same time, what the data has shown us is a couple things. One, just to put some numbers around it, payrolls has decelerated from around 600,000. Prior to the revisions, it looked like job growth had slowed to around 250,000. Now with the revisions and the new data point, job growth is actually running on a 3- and 6-month moving average basis at 350,000. Now look at CPI. CPI 3-month core CPI annualized rate was running around 8%. It came down to around 3%. Now after the revisions, that 3% is more like 4.5%. So if you just look at the landscape right there, the improvement is happening, but it's happening slower than we originally anticipated or originally was shown in the data. And as a result, it's too soon for the Fed to stop hiking, at least for now, at least 2 more rate hikes expected.
Kelsey, these are real changes. You've gone through the economic data, and so many people who came into this year with a bearish view on the economy has had to recalibrate and change the probabilities around a range of outcomes, a range of scenarios. I want to understand from your perspective just how close we are to being sufficiently restrictive at the Federal Reserve, whether financial conditions are easy or whether they're tight. Because you've been pointing towards the Senior Loan Officers Survey, which screams tight conditions. I'd look elsewhere at equities and credit in public markets, and that screams things are easing. Which one is it?
Yeah, so this is absolutely the most important question. We know the Fed is getting to at least 5%. So the question is a 5% Fed funds rate sufficiently restrictive? Now, of course, it's reasonable to ask that question because the data this month has been incredibly strong, but we're trying to look at the big picture, and there are signals in the market as well as in the economic data that suggest that policy is still becoming significantly restrictive. So I'll point to 3. One is the highly inverted yield curve, right? It's telling us that growth is going to be slowing, and it's being coupled by low 10 and 30-year inflation break-evens. The Fed has credibility that they are going to get inflation down no matter what, whatever it takes. The second, this is what Powell's been pointing out, high real yields across the curve. You look at the TIPS curve, real yields are at least 1.5% across the curve. That is a very high level of real yields consistent with tight financial conditions. Now, of course, the financial conditions indices themselves are all based on asset price movements. But what I've been focusing on is that Senior Loan Officer Opinion Survey, which is not just about asset prices, but it's about credit conditions. And banks are telling us they are tightening credit standards and loan demand is falling. And this has been, over the last 30 years, a highly predictive indicator of rising defaults and slowing real GDP. It's all happening a lot slower than we anticipated, but it is still showing up in the data. We do think that when we get to 5 to 5.5, policy will be sufficiently restrictive enough for them to pause.
That last line, though, is so important. It's happening more slowly than we anticipated. Now, John, I understand the need for patience, and you get paid to wait. I've heard all of that. You get 4.6% on a 2-year. You get more on T-bills. I get it all. You get paid to wait. Have patience. It's a process. Wait. You came into this year, John, you said recession foretold, you're underweight equities, and then all of a sudden the S&P's up 8% year to date, and the Nasdaq's up 15% year to date. How much longer can you sit that out?
Yeah, I think, this is an environment, the framing I think is important, and I think we're of this environment, and also to remind people maybe that the horizon we have in mind when we make these calls is like 6 to 12 months. Within this environment that we think is structurally more volatile, there can be periods where, there might be very significant trading opportunities, and I think January was clearly one. We've seen the market going with some hopes of, perfect scenario materializing, and that can run for weeks, as we've seen. And then, if you can time it, you wanna be long that period. But I think more structurally, more fundamentally, these episodes are more short-lived. I think we're gonna see more frequent reversals because of the nature of this environment. And I think they are triggered by the fact that the central bank is not going to let go or ease up on inflation that easily. And we're going to get reminded every now and then. And I think we're at that phase now of the pause in the rally, this being reassessed. And I think this is in line with this broader kind of environment where we are going to see, a period that looks bullish, but they're going to be not the prelude to, quarter-long, decade-long, year-long bull market. So much more quicker reversals.
Jean, there are these big disconnects that I think are leading to a lot of people just sitting there scratching their heads trying to figure it out. Futures are down today by 1% on the S&P. On the Nasdaq, we're down by 1.4%. But take a look at what's been happening in the bond market. I know you guys follow it closer than I do. The 2-year had a closing low on January 18th at 4.08%. The 2-year right now is at 4.63. That's a 55 basis point move on a 2-year over that period. John, if you take a look at tech, the Nasdaq, over the same period, we've had a real rally. We saw it again yesterday. What explains the outperformance in tech this year, Jean, against the backdrop of everything we've been talking about? Better data, high yields, and a pressure on the Fed to do more.
Well, I think the disconnect is somewhat broader, right? I think we've seen, a very significant repricing on the rate space. As you've just mentioned, the 2-year is a key gauge of that. But if you just look at the policy path, right, we've seen like more than 100 basis points reappearing in the curve over the next 2 years in terms of policy path. And moreover, a couple of weeks ago, it was impossible to contemplate Fed erring on the side of more than 5 or 5.25, and now we have calls that are much higher than that. So we're getting more to a two-sided debate on the policy path and a path that is higher. That has been reflected in fixed income, but the equity side of things for now is telling a different story. I don't know if it's based on hopes that is more focused on the activity side of things that is more resilient. But again, I think ultimately it's a question about, is it the old playbook that we should be applying? The old playbook would be one where if you see strong activity data now, you expect things to be better? Or is it like the new playbook where we're dealing with inflation and stronger activity now means more pain to come after? And I think this is a tug of war between the rate market versus the equity market at this juncture, which I think we'll need to.
It's a super difficult moment for so many people, Kelsey, because you can nail the Fed call. Let's say you came into 2023 and said, I think this data is going to be resilient. I think this Fed's going to have to go further. I think this risk the terminal rate is higher. You nailed it. Great. But then you had to make an equity call, a call on risk off the back of that. Maybe you would have said, I don't think tech's going to do well in that world. I don't really like risky credit. The Fed's going to have to do more. We're going to see some demand destruction. And then Kelsey, risk has absolutely ripped. Do you want to stay with some of those moves?
Yeah, so here's the thing that I think is comforting to markets more broadly is what caused all of the pain last year was the fact that we went from 0 to 450. I mean, that's 0 to 100, essentially. It was a massive pivot from the central bank. What we're talking about now are incrementally more hawkish moves, right? So, even if we get an extra 25 or an extra 50 or even an extra 75. This is not the level of pain that we're going to observe in the bond market that we saw last year just because of the starting point. And that's why, we can remain convicted on the idea that fixed income has a place in your portfolio this year. We've been saying to stick high quality. If you look at the investment grade excess returns so far for 2023, they've already nearly recouped all of the losses in excess return terms that they lost in 2022. So being high quality, remaining invested, getting that income has benefited you because the delta on the amount of aggression from the Fed this year versus last year is very different.
That wall of demand of fixed income has been absolutely phenomenal. Kelsey Barrows, Jean Bavin are going to stick with us. Equity futures right now down a little more than 1 full percentage point on the S&P. The opening bell about 15 minutes away. Coming up, China slapping fresh sanctions on U.S. corporates.
The PRC's attempts to accuse us of doing the same. It is just more misinformation, disinformation. It is just not true.
That conversation up next.
is watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great
evening. Here's what I'm watching. You do not want to miss this story. There, the kind of upside.
The United States is always going to take responsible, prudent, and appropriate actions to protect our people. That is precisely what this government did in response to the PRC violating our sovereignty, violating international law by sending a high-altitude surveillance balloon. This is not the type of program that the United States is conducting over China. The PRC's attempts to accuse us of doing the same. It is just more misinformation, disinformation. It is just not true.
US-China tensions running high. Beijing imposing fresh fines and sanctions against 2 US defense companies. The nation's foreign ministry warning recent events could jeopardize talks between top diplomats in Germany, saying the following: the US cannot ask for communication and dialogue on the one hand, while sharpening differences and escalating crises on the other. Emily joins us now in Washington. Hey, Emily.
Hey, John. So this is going to be the next big test for U.S.-China relations coming up later this week at the Munich Security Conference. Does Secretary of State Anthony Blinken take time to meet with China's foreign diplomat Wang Yi on the sidelines of this event? Of course, they were supposed to have that meeting, and then that's a Chinese balloon flew over the U.S., then we shot it down, and then there has been this back and forth with the U.S. putting Chinese companies on various sanctions lists, and now, of course, the sanctions coming out against the subsidy of Raytheon, as well as Lockheed Martin. And this just shows tensions are still very high between the two countries. There's still a willingness to work together. Remember, Biden tried to get that underway last November with his meeting with Chinese President Xi Jinping. But of course, some of these recent events have really sort of led to a heightening of tensions. And I think there's a big question as far as where the U.S.-China relationship goes after this.
Emily, thank you. We'll cover that, the Munich Security Conference tomorrow. Looking forward to catching up with Emily and Maria today. I want it. That's the bearish view on China, the geopolitics, the relationship between the US and China. The bullish view is China's reopening, and wow, look at Europe benefiting from it. The FTSE in London, all-time high. The CAC 40 in Paris, record high earlier this morning. 2 names that report tomorrow: Air France KLM and Hermes. Look at these moves year to date. Air France up 36%, Hermes up more than 20, close to 20%, up more than 19 percentage points year to date. Jean Bavin, US equities hasn't worked out. Do you still like the rest of the world?
We as you say, I mean, we think the developed equities in general, are in a position right now where the risk is clearly apparent, and I think the last few weeks are showing that. We are looking more broadly, and the EM landscape in this environment on a relative basis is starting to look a bit more attractive to us when we talk about equities. There's a bit of momentum coming from China powerful restart, and the knock-on effect this is having more broadly, I think, is part of the news and the new development we've seen since late last year. So that's part of that thesis, and the broader resilience that they've continued to show. So if we're approaching kind of a more nuanced phase of monetary policy in DM economies over the next few months, I don't think we're there yet, but this is a story for 2023. This environment could be relatively more attractive for EM equities in general. So we're warming them up a bit more to that space, I guess.
Kelsey, John's not alone. a lot of people have been looking at the US and saying it's not going to be the year of the US. They've been wrong. The US has done pretty well. I look abroad, though, EM, China, Europe, all feels like three flavors of the same story. China's reopening, a better growth profile, a more resilient story. Kelsey, where are you on those themes right now?
Yeah, so we've been leaning into that recovery theme, particularly in Europe. So one of the noticeable things that we saw or observed recently, European high yield has been spreading above U.S. high yield for quite some time. Those spreads have actually recently converged, which essentially reflects that improving growth picture in Europe via tighter spreads. Spreads are tightening even faster than they are in the U.S. high yield market. So that is something that we've been leaning into, not just because of the China reopening story, but also because undoubtedly this winter has been very kind to Europe. The warm weather has helped, and it put the continent in a much stronger position for 2023.
Big change from what we expected. Kelsey, John, to the both of you, thank you. Some big themes we've got to work through. The hard data from the United States year to date. January has shaped up things big time, the January economic data. Futures breaking down by 1.2% on the S&P. We'll see if this sticks. Yields a little bit higher at the front end, much higher at the long end. On a 2-year, higher by a basis point or two, close to 4.65. Coming up, the morning calls, and later, Richard Bernstein of RB Advisors warning investors this year's speculative rally is based on false hope. More on that around the open in about 7 minutes away.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Away from the opening bell, equity futures negative a little more than 1% on the S&P. As the price action, let's get you some morning calls. First up from Bernstein, downgrading TripAdvisor to market perform, highlighting the stock's expensive valuation and concerns about its new investment strategy. The second call from Deutsche Bank, upgrading Activision to buy, seeing strong momentum across key franchises and a compelling risk-reward. That stock a bit softer, down a third. And finally, Atlantic Equities upgrading Roku to neutral after earnings, encouraged by management's plan to cut operating expenses. We're flying there by more than 9%. Coming up, Richard Bernstein says inflation isn't dying. It's time to fade the speculative rally and look abroad. That conversation just moments away. Your opening bow just around the corner. Futures down and down hard.
a book about YouTube now? Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
What a fascinating morning so far, and good morning to you. About 20 seconds away from the opening bell, equity futures down a little more than 1% on the S&P, on the Nasdaq down about 1.6%. Jobless claims, downside surprise. PPI, upside surprise. Fed speak, Loretta Mester of the Cleveland Fed. Loretta Mester saw compelling reasons to go 50 basis points at the last meeting. Equities down and down hard. That's your opening bell. Switch on the board and get to the bond market. Yields look a little something like this on a 10-year higher by 4 basis points to 384. We are near the highs of the year across the curve on a 10-year at 384. On a 2-year at the moment, just short of them, up 2 basis points, close to 465 after coming close to 470 at 469 intraday in yesterday's session. Dollar showing a bit of strength, euro some weakness, back below 107 at 106.71. We're negative 0.2% there, and crude just about holding on, $78.60. We're unchanged on the session. About 30 seconds into this, equities down 1.1%. We'll see if that sticks. On the S&P, on the Nasdaq, we're down 1.4%. Bear in mind, we've had tons of outperformance on the Nasdaq so far year to date. Let's get you one name, Cisco, moving higher after delivering an upbeat forecast. The CEO, Chuck Robbins, expecting demand to continue, saying this: I don't want to paint a picture that we're immune, but we've been able to see our customers moving forward with their projects. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, Jonathan. Shares up around 3%. Anything above 3.5% would be the biggest jump since November. The stock trading at its highest level since around May of 2022. A lot to jump on here. They're bucking the trend of what we're seeing in corporate America. Initially, for the coming quarter, the period ending in April, they see sales rising 11 to 13%, almost double what the street was anticipating they'd say, thinking that they would say sales would grow 6%. Those are the numbers that they just printed. Additionally, for the full year, the guidance was strong as well. We're going to see top line growth of 9 to 10.5% in fiscal 23, and profit will be around $3.73 to $3.78 a share. Around a dozen analysts, John, have raised price targets on Cisco or upgraded their call on the stock. One reason being that basically during the pandemic period, Cisco had a backlog of orders. They kept the new business coming in, and now they're managing that process very well. There's still a pipeline there. The kind of harder story to quantify is actually Cisco's finding relevance right now. Yes, we know about layoffs. Yes, we know about companies pulling back, but they're handling a lot more data, which makes Cisco's offerings all the more attractive at this time. But really, it's that handling of the order backlog, the bullish outlook going forward. And as I said, that stock pushing higher, bucking the the trend of the market this Thursday.
That stock's up right now by 3.8%. Ed, thank you. Different story for Paramount. Weaker advertising revenue, offsetting gains from its streaming service. For more, here's Katie Greifeld. Hey, Katie.
Hey, John, of course, we're talking about Paramount. Media giant owns CBS and other networks as well. It's taking a dive this morning after, like you said, it reported fourth quarter numbers that missed on both sales and profit, which ties back to that very familiar story. Advertising. Of course, ad sales for the legacy TV business dragged down results, even though the streaming side continued to grow. So you add that together, shares are down about 6% or so this morning, even though media overall has been a bright spot in 2023. Warner Brothers Discovery leading the way there. It's up over 60% or so year to date. And even with today's dive, Paramount is still looking at year-to-date gains of almost 40% or so. And a lot of those gains, of course, are coming from optimism over the streaming business. So let's take a look at the subscribers, what we're actually talking about here. Paramount, it added almost 10 million new subscribers in the fourth quarter alone. That brings its total to 56 million. As you can see, that's still dwarfed by the likes of Amazon and Netflix and even Disney Plus, but the trajectory seems to be higher, John.
Katie, thank you. That year-to-date board is absolutely amazing. Katie, thank you. Let's bring that up again if we can. Paramount, year-to-date, up 36%. Warner up like 57%. Walt Disney up something like 23%, 24% higher. It's just phenomenal year-to-date gains on some of those names. Not just those names, but the travel names as well. Hyatt posting per room revenue forecast well below its competitor Marriott. Those numbers came this morning. Here's Abby with more. Hey, Abby.
Hey, John. Yeah, it's a similar story. We have the travel stocks absolutely on fire this year, of course, because we've had this continued demand, a surprise to many people. A year ago, it was revenge spending, revenge travel after the pandemic, but here we are a year later, and we're still seeing it. So in the case of Marriott, it's so amazing, or excuse me, Hyatt, it was actually at a record high yesterday. Today, as we were just showing, not so much, down about 4% or more, but a very strong quarter. They beat adjusted earnings. They put up $2.50. That's a beat by 622%. Revenue's better, net income better by almost 700%. So again, this is the kind of strength that these companies are seeing. On the other hand, a flip side of it, RevPAR, a measure of revenue per room, because during the pandemic there were fewer travelers, we're looking at uneven comps. So they're looking at 10 to 15% RevPAR growth this coming year. However, excuse me, this coming quarter. But when you compare it to a year ago, well, it's going to be a tough comp. So that could be weighing on shares. But let's take a look at another year-to-date board. Not quite as dazzling as the media board, but here are the gains in the travel sector. The key takeaway is this massive rally. Some of it could have to do with the savings rate dropping, John. Right now, the personal savings rate here in the U.S. around 3.4%. Off of that pandemic peak of 34%, maybe a lot of that money coming out of bank accounts as folks want to get out there and live, going into these hotels, airlines, gambling, all of it.
So impressive, these year-to-date gains again. Abby, thanks for that. Just the broader market at the moment, this morning, and 5 minutes into the session, we're down a little more than 1% on the S&P. On the NASDAQ, we're down by 1.4%. Wall Street really struggling to figure out this market. We've had calls for a more aggressive Fed, getting some validation, that's for sure. This year's rally, though, suggesting otherwise. JP Morgan's Marko Kolanovic saying this behavior isn't just fighting the Fed, it's taunting it. RB's Richard Bernstein telling investors to fade the move higher. He says this, it's based on the hope the Fed will soon return cheap and abundant liquidity. It's highly unlikely. The Fed has no intention of being the hero of speculative investments. Richard, I'm pleased to say, joins us right now. Richard, great to have you with us on the program. Let's start here with this regime. You said rates high for longer. You said sticky inflation. You've nailed those calls. What you've struggled with is the equity leadership, tech. Why is tech outperforming year to date against that?
So, John, good morning. I think tech is the epitome of that speculative fervor that's still in the market. You know, as you pointed out, somebody had said that the ultimate fighting of the Fed. Speculation requires huge amounts of liquidity, cheap and abundant liquidity. And if you think about, 2020 to 2021, we certainly had cheap and abundant liquidity, records amounts of cheap and abundant liquidity. The Fed is now trying to sop that up. But you have this hope among speculative investors that we're going back to that previous regime and that inflation will suddenly subside, the Fed can ease, we'll have sub 2% inflation, and we go right back to that speculative environment. We just think that's very unrealistic, given the economic data, given the Fed, we think the whole regime is changing, but yet investors haven't caught on to that yet.
So, Richard, I struggle with this. I've always struggled with the idea that there's a room somewhere that exists on trading floors where the bond guys sit, and they sit and trade bonds, and they know something the equity traders don't know because they sit somewhere else and no one talks to each other. Are we saying the bond market's right and the equity market's wrong?
I'm not so sure about that, Jonathan, because if you look, if we take away treasuries for a second and we look at credit spreads are very narrow. Given that we're sliding into a profits recession, one would expect that credit spreads would be wider. But credit investors right now are similar to the speculative investors, somehow saying this time is different. That, we're going to have a profit recession, but credit will be fine. That's a little bit hard to figure out. So I'm not sure that bond investors are looking at anything differently than speculative equity investors are.
How do you think this reconciles? What do you think will resolve this issue?
I think unfortunately for a lot of people, it's going to be disappointment yet again. I don't understand why people still are momentum investors. I think you would have thought that 2021 into 2022 would have washed out the momentum attitude and people would have become more fundamentally based. But clearly that has not happened. And so that sets up what's the downfall for momentum investing is always hanging on too long. That's where you underperform as a momentum investor, and I think we're going to see that again.
So part of the equity market you have liked, and let's be clear about this, you haven't just hated equities, you just didn't like tech and didn't expect the leadership to come from the US or from tech, and that's where the outperformance has been. You have liked Europe, and you have liked the rest of the world. So let's go there. Richard, the year-to-date gains in some of these European names is really impressive. I talked about Hermes, the luxury goods maker, Air France, KLM, one of the biggest carriers in Europe. Those year-to-date gains were up like 20, 35%. Got record highs in France, record highs in the UK. Do you see reason for that to continue, even against the backdrop where you think tech and US equities could run into trouble?
Yeah, so I think, let's look at this from a purely investment point of view for a second. Just kind of get down in the weeds. I hate to do that, but let's do that for a second. The U.S. market is dominated by three sectors. It's dominated by tech, it's dominated by consumer discretionary, and dominated by communications. Those three sectors still make up about 45% of the U.S. market. That is not true in the rest of the world. And what we found in 2022 was that country performance was directly related to how little exposure the country had to those three sectors. So our attitude is that we just don't like those three sectors. Everything else is fair game. Our attitude is that the menu of investment opportunities, whether it's not in those sectors in the United States, whether it's in other countries, whether it's in other industries, the menu of opportunities is extraordinarily broad. It's just that nobody wants to look outside of those three sectors in the United States. So John, yes, I think there's plenty of opportunities, whether it's in Europe, whether it's in Japan, whether it's in China, whether it's in energy, whether it's in consumer staples. I think the menu of opportunities is very, very broad right now.
What's clear to me, though, Richard, is you're looking for some of the outperformance so far this year, to run into some trouble. And I'm trying to work out when it indeed does run into trouble, if you are right. How does Europe look in that kind of market? Are we looking for relative outperformance, or do you still expect absolute performance, positive returns against the backdrop where you think the US equity market's going to run into trouble?
Yeah, that's a very fair question. I'm really talking about relative performance. Look, we're in an environment globally, with the exception of China for a second, where central banks are tightening and profits are decelerating. Right? In China, you have the opposite. Profits are accelerating and the central bank is easing. But outside of China, that's generally the way to think about it. In fact, I think it's about 45 or 50% of the world's yield curves are now inverted. So we're not looking at what would normally be a great environment for equities overall, right? You'd like to see central banks easing and profits accelerating, not the opposite. So I think we are talking a little bit about relative performance. However, one has to remember that volatility always signals a change in leadership. So if that happens, and if the global economy is changing, we're starting to see that change of leadership in a bearish environment, that signals that the new bull environment will have very different leadership than this tech consumer communications type leadership that everybody wants to have be the leadership.
Just thinking about risk reward at the moment, though, Richard, here's the challenge for a lot of people. Do I want to play that complicated game of relative outperformance in equities when it's really tricky right now and the incoming information is telling me that a lot of people, their consensus view on this economy in the US may well be wrong, when I can just take a 6-month T-bill, sit on 5%, and sit this whole thing out for the rest of this year?
Right. Well, John, I realize everybody is a perfect market timer, and we all get back in at the perfect moment. I get that one, but let's assume for a second, for those of us who are maybe not that perfect, I think the relative performance game is important because you want to keep a certain equity exposure within your portfolio, right? Assuming that one's trading for quarters and years and not for days and minutes, that basic equity exposure remains very important. So I think, look, I think, you know, we all kind of poo-poo relative performance, but I think it's very important in terms of longer-term performance to keep some kind of a reasonable equity exposure.
I'm not looking for perfection. You know that, Richard. Never. Richard, thank you, buddy. As always, it's good to catch up. Richard Bernstein there on this market. Equities right now down 1.2% on the S&P. 13 minutes in on the NASDAQ, we're down 1.4%. Coming up, here's a headline for you. President Biden and Elon Musk kind of reconciling.
Tesla has dominated the EV market. It still does. It still will.
That conversation up next.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Price of electric vehicles, at one point it was the average price in our calculations was about $66,000. That's more than the household income for most Americans. So we are seeing that come down a bit, some of that because of Tesla's moves. but also because we are seeing automakers start to introduce less expensive ones. Tesla has dominated the EV market. It still does. It still will.
President Biden offering rare praise for Tesla's CEO, writing in a tweet the following: Elon Musk will open a big part of Tesla's charging network up to all drivers. That's a big deal. It'll make a big difference. The move, making Tesla eligible for funding as part of the bipartisan infrastructure law. Team coverage starts right now with Bloomberg's government's Jack Fitzpatrick in D.C., Ed Ludlow on the West Coast again. Jack, first to you. Are we making friends here?
It hasn't exactly been a romance between Biden and Musk. This is an interesting little detente because there had been times when Biden wanted to talk about electric vehicles and had kind of made a point of excluding Tesla. There was an event with Ford and GM that they weren't invited to. I don't know that it's going to be an absolute thawing of that relationship. Some of the Twitter politics has gotten between them. So I don't know if it has become, I guess, brotherly love between these two. But it is a notable thing that has connected Musk and Tesla to some of the money available under the infrastructure bill that was enacted last year.
Ed, what do you make of this?
Yeah, look, it's important for the broader push to electrify. The pledge from Tesla is 7,500 chargers split across 3,500 super fast chargers and around 4,000 more sort of standard installations. You know, I think back to July of 2021, John, and I think about the stock. I think about Tesla. Goldman Sachs in July of 2021 published research that said if Tesla ever did this, they could realize annual revenues, additional annual revenues of $25 billion. And that's been the frustration with Tesla, that actually if they opened it up, their brand and their kind of incumbency in this market, that would give them another lever, right? Even if people aren't buying their vehicles, it's another service that they can offer. But just like Jack, I don't necessarily think this is a full-on detente. You know, Musk has felt pretty aggrieved in the past, but for the broader initiative to expand charging infrastructure, it's important, but Tesla's still a #2 player in this country. Don't forget ChargePoint, which we talk about less, has many more chargers across North America.
And I've always thought it was bizarre that this administration didn't include Tesla in more conversations, including Elon Musk. Elon Musk has talked about it. We've all said the same thing. It doesn't look right. But Ed, what it seemed to come down to was union workers, which this president just keeps going on and on and on about.
Yes.
Ed, can you tell me what's the latest on that front with Tesla?
Yeah, so overnight, according to a complaint filed by the workers at a Buffalo, New York plant, some individuals have been terminated in the last 24 hours or so, having initiated an effort to organize a union effort on Tuesday in the same plant. This effort relates to a small group of employees who are autopilot data labelers at the Buffalo facility. In total, there's 800 people on that team. And, you know, they were basically pushing through an affiliate of the Services Employees Union to do this. There's been no response from Tesla, but, you know, all we have to go on is this complaint that's been filed that says, following that effort to organize, following actions that they took on Tuesday, February 14th, handing out leaflets to their colleagues in that plant, some of them have been dismissed.
Jack, is that where there's daylight between the president and Elon Musk over this issue?
That's where there's a big portion of the daylight. There are some other areas. Again, the interest in social media and Twitter, I think, has gotten between them. There was an instance in which the president said it might be worth looking at his connection to foreign investors. They have political differences. You know, you even look at recently the decision by Musk to go visit Kevin McCarthy. You also happen to essentially bump into Hakeem Jeffries. Really, they have political differences, and it gets into the union stuff, some of the foreign investment, and even social media. I think there are a few issues like that that get between those two personalities, but there is a clear bridge between them in the president's interest in investing in electric vehicles and the related infrastructure.
Ed, I want to give you the final word. It doesn't seem to make the slightest bit of difference for the stock this year, at least, year to date, of 73%.
Yeah, I think we're under a little bit of pressures in this session. I think that has a lot to do with the broader market and the Fed comments. But, you know, Tesla has revived its fortunes. It's shown that it can use price cuts as a lever to initiate demand. And I think that actually the street was relatively bullish on its last earnings print for this year. All eyes on March 1 Investor Day, where we get the kind of next 10 years worth of planning. But, you know, Tesla has momentum, still trades at a pretty high multiple, though, John.
What a year-to-date rally. Ed, thank you. Ed Ludlow on the West Coast, Jack Fitzpatrick down in DC. Your equity market more broadly, 22 minutes in, we're down 1% on the S&P, on the NASDAQ, down 1.2%. Let's lift the lid on some of these indexes and get you some sector price action. Here's Abby.
Hey, John. Well, not surprisingly, with that decline for the S&P 500, the worst day of the month, we are looking at 8 of the 11 S&P 500 sectors trading to the downside. What's so interesting is this expectation that the Fed is going to continue to have to lift more than what had been thought just a couple of weeks ago. That is shaping the sector positioning because we have real estate and utilities. Those are the worst two sectors, both down 1.6% or more. That has to do with the fact that their dividends look less attractive when yields go higher and the expectation that they may go higher yet. On the year, if you want a year-to-date board, John, let's check this out because the crypto space, it really even puts media and travel to shame. Take a look at the Bloomberg Galaxy Crypto Index, up 49%. Coinbase, up 85%. Marathon Digital, Riot platforms also up in a big way, a double, having to do really with this risk-on mood and folks really moving to momentum.
Abby, thank you. It's truly impressive. Richard Bernstein was talking about it 20 minutes ago. Can this continue against the backdrop of higher interest rates and higher yields? 367, 467 almost right now on a 2-year. Coming up, your trading diary.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
26 minutes in, almost. Yields up, stocks down by 1% on the S&P, down by 1.2% to be precise on the NASDAQ, down by 1.25%. How much of this will get bought through the rest of the session? Look out for that. That's the price action. Here's the trading diary. Coming up, DoorDash, DraftKings reporting results after the closing bell. Fed speak continues. Bullard, Cook, Mester, all on deck this afternoon. Richmond Fed President Tom Barkin, Fed Governor Bowman speaking on Friday. And finally, the Munich Security Conference kicking off tomorrow in Germany. We'll catch up with Maria Tadeo going into the weekend. From New York City, that does it for me. Thank you for choosing Bloomberg TV. And as always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg TV.
watching and says, I want to be Ari Emanuel when I grow up? What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million.
It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds, they can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement, encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as described about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero. I aim to be a top-notch engineer. I am a Swero. I aim to be a top bureaucrat of this country. I'm a Swero. I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College. And then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and